Yes, people, very, very happy to all of you. So, guys, we're doing this chapter called as preparation of the financial statement of a company. So, guys, last class we started a discussion on the balance sheet part, right? So, in that we have completed our understanding on shareholders' funds and share application money pending allotment, right? So, let's do a quick recap. Yes, in the last class we understood why did we shift, from a horizontal format of preparing balance sheet to the vertical format. So I give you two big logical reasons behind it. Just a justification of why we're going for a vertical form of the balance sheet, right? So if I focus on the liability side, please tell me on the liability side how many broad categories of equity and liabilities do we have? Four broad categories. In that, the first category is shareholders fund. Second category is
Shareholders fund.
share application money pending allotment. Third is non-current liability.
Non-current liability.
Fourth is current liability. For these four categories, the main heading is what? Equity and liabilities. Equity is singular, liabilities is plural. Under shareholders funds, we have how many bifurcation? How many subcategories? Three subcategories. First one is share capital. Second is reserves and surplus. Third one is money received against share warrant. Wonderful. In share capital, against note number 1, you will give the description of the share capital. So basically, in this particular note, you have to disclose certain information. What are we supposed to disclose? So the first part is authorized capital. What is authorized capital? So this is the maximum capital that the company can raise during its lifetime. If I want to raise the capital beyond authorized capital, what am I supposed to do? I have to make the amendment in the memorandum of association. Under which clause? Capital clause. Okay, Purvi wanted, so I said. Second, this authorized capital is also called as registered capital or nominal capital. All this information, where am I getting from? CA Foundation. Now, in this or under this, we have to disclose how many information? 3 information. One, you have to disclose what is the number of shares. Second, what class of share? Equity or preference. In preference, we have multiple class of shares. 9% preference share, 10% preference share, 8% preference share. These are multiple classes. And you have to mention the face value of each class. And in the outer column, you record the total authorized capital of the company. This is one segment. Under that, the second segment is issued, subscribed, and paid up capital. What is issued capital? Sir, this is that part of issued capital is a part of authorized capital which is offered to public for subscription. Wonderful. What is subscribed capital? Subscribed capital is a part of issued capital which has been subscribed by the public. Paid up capital is that capital which has been paid up, called up by the company and paid up by the shareholders. Under this, you have to disclose how many number of shares is being issued, what is the class of the shares that is issued, and what is the face values that is being issued. Out of this, if any person has not paid any money, that amount is called as calls in arrear, and that you have to subtract from the paid up capital. So this is totally, in that case, becomes called up capital. And from that, if you minus unpaid capital, then this will become my paid up capital. Am I loud and clear? So always in the outer column, what do we have? Finally, paid up capital. And this is what is traveling to your face of balance sheet. So on the face of balance sheet, under share capital, which capital travels? Paid up capital, paid up capital, paid up capital. Am I loud and clear? Now here we discussed very two important disclosures. Here we had discussed about very two important disclosure. One is issue of share for consideration other than cash. Means what? Normally what happens? I issue the share. The company is issuing the share. In return, what do we get? Cash. But in this case, what happens? We issue the share, but in return, we don't get cash consideration. We get non-cash consideration. What is the meaning of non-cash consideration? We're getting something other than cash, such as I'm getting either service or some asset, or I'm getting the business. I'm buying the entire business as it is. So this is called as non-cash consideration. So whenever you're issuing the shares like that, you have to give the disclosure of that separately in the notes to accounts. This a lot of accountant forget to give. So as a chartered accountant, when you go to any company to audit, the statutory audit when you carry on, you have to check if there is any non-cash consideration that is being issued during the year, and that disclosure without forgetting, you have to capture in your notes to accounts. Will you forget this point? My question is, this disclosure of non-cash consideration should be given for how many years? Only 1 year of the year in which the issues happened. Apart from that, we have one thing called as no cash consideration. No cash consideration here refers to bonus shares. What is bonus shares? Bonus shares is basically the company is issuing additional shares. The company is issuing additional shares to whom? Existing shareholder, which is absolutely free of cost, which means I'm giving the shares to the shareholders. I'm not charging anything in return. This concept of bonus share in depth, in detail, where did we study? In CA Foundation. Now, when company is issuing bonus shares, the company is supposed to give a disclosure of the same in the financial statement. We have questions based on these both. We have questions based on these both because at the CA intermediate and CA final level, more than how to prepare the financial statement, they'll be more vigilant on how you give the disclosures. Because even computer system AI can prepare the financial statement, but what they cannot do is a disclosure requirement because that is something which we have to decide on case to case basis. So your role will be significantly in how the disclosures are given. So here, if the company is issuing bonus by any chance, the information about the bonus issue needs to be disclosed in the financial statement where in notes to accounts. And this disclosure should be given for 5 years, including the current year, the year in which the bonus shares are issued. Are we supposed to share the source from which the bonus shares are issued? That is not required. Schedule 3 does not compel that. That also we discussed in the last class. Yes, sir. Then we discussed something about reserves and surplus. We understood what is reserves. We understood what is surplus. Reserves is nothing but the savings that is made out of the profits. So whatever profits we earn, from that we segregate a portion of it in form of reserves. Am I loud and clear? What happened to this? Yeah. So reserves is basically your savings. I give the example how we earn whatever monthly earning we have at home. A part of that we have the habit of saving. Now savings is of two types. One is general saving. Second is specific saving. Like that also we have here general reserve and we have specific reserve. Specific reserve means what? The reserve what you've created for whatever purpose, for that purpose only you can use that money. You cannot use that money in reserves for any other purposes. So like that we have specific reserves and we have free reserves. Now these reserves could be created out of two types of profit. This is a new point I'm telling you. Reserves here are created out of two types of profit. One, the reserves are created out of revenue profits. Second, the reserves is created out of capital profits. This we have already discussed where in the CA Foundation where when we discuss bonus issue, rights issue, redemption of preference share, redemption of debenture, that time also this concept was triggered. So what is the meaning of reserve created out of revenue profits? Revenue profits means what? The profit that is generated by you in the business at the core business activity level and the non-core business activity level, which means you are putting efforts to earn that revenue. That is called as revenue profit. Revenue profit means the profit that is generated at the trading and P&L account level or the statement of profit and loss account level. For example, the sales what I do, can I say it is increasing my profit? The commission income increases my profit. So all these will lead to revenue profit. So the reserves could be created out of revenue profits or the reserves could be created out of capital profits. What is the meaning of capital profits? The profit that is generated by the balance sheet item. Listen to my words very carefully. I'm telling you the profits that is generated by whom? The balance sheet item at the balance sheet level is called as capital profits. What is revenue profits? The profits that is generated by revenue items at the P&L level is called as revenue profits. Sale, if I do sale of books, if I do coaching fee income, that is my revenue item or capital item? It is a revenue item. So it goes to your P&L account. Can I give an example of capital profit? What is it? Better example. When you forfeit the shares, you have the amount in forfeiture account. When that amount could not be utilized for reissue purpose, means you have done the reissue at premium, means whatever the money is there in forfeiture account, you will transfer to capital reserve. You transfer to capital reserve. So this capital reserve is created out of capital profit. Means what? This profit is generated by the balance sheet item. Which item helped you to generate this capital profit? Share capital. Sir, can you give example? Very simple. You issued 100 shares. You have issued 100 shares. In that, a gentleman has paid 6 rupees. 600 rupees you have received. How many rupees he has not paid? 4 rupees per share he's not paid. You called him multiple times, but still he is not paying. So one point will come and he'll get frustrated. So what will you do? You will cancel his share. Means you will forfeit his share. So when you forfeit the shares, whatever amount you receive, this 600 will be transferred to your forfeiture account. Will be transferred to your forfeiture account. Correct? No? Now, these shares were subsequently reissued at 10 rupee. What is the face value of the share? 10 rupee. You have reissued at 10 rupee, which means when I gave the same 100 shares to somebody else, he gave me on this 100 share full 10 rupees. So he paid me full 1000 rupees. Now, this 600 rupees is lying where? In your forfeiture account. So what will you do there? Upon the reissue, if there is any money unutilized in the forfeiture account pertaining to these shares, you are supposed to transfer to capital reserve. So this 600, which is now in the share forfeiture reserve account or share forfeiture account, will be transferred to your capital reserve. So capital reserve is your capital profit. Tell me how. You gave this 100 shares to somebody else. New person. He gave you 10 rupee per share fully. So 1000 rupees you got. So you gave 1000 rupee worth of share to him. You got 1000 rupees. Apart from this, you also have extra 600 rupees from the previous person. So this is extra money that you made. This is extra profit. So in total, for this 100 shares, how much money you've got totally? 1600 rupees totally have got. From person 1, that is shareholder 1, you got 600 rupees. From shareholder 2, you got 1000 rupees. Total 1600 you have. The share is worth how much? 1000. But how much did you get? 1600. So that 600 extra is profit, no? So this profit is because of which item? Shares. This 100 shares. Share is what item? Capital item or revenue item? It is a capital item. So if any profit that is generated by the capital item at the balance sheet stage is called as capital profits. Am I clear? So these reserves could be either created because of the revenue profits or it could be created because of the capital profits. Revaluation reserve is a result of what? I know. Is it because of revenue profit or capital profit? It's because of capital profit. So it is created at the balance sheet level. Capital redemption reserve also is created at the balance sheet level. Security premium reserve also created at the balance sheet level. Debenture redemption reserve created out of balance sheet level. So all these reserves are created out of capital profits, which is balance sheet items. Now, if at all, let's suppose I create something called as workmen compensation reserve. Workmen compensation reserve. Is it free reserve or non-free reserve? It's non-free reserve because I cannot use that money for the purpose of distribution as dividend. It is only for a specific purpose, which is towards workmen. Now that is created out of revenue profits. That is created out of revenue profits. Am I loud and clear? Now, workmen compensation reserve, technically speaking, we can actually use for distribution as dividend. When in event of winding up, when that money is going to be unutilized, then you can use the workmen compensation reserve. Am I loud and clear? Non-free reserve means what? Law says created, you cannot use it for any other purpose at all, other than the purpose what I say. Who's saying this? Company law. Company law says that these reserves I wanted to create. And I want to use this money only for the purpose what I say, not for your own purpose. You cannot give this money freely to anybody. That is called as non-free reserve. Then we have something called as free reserve. What is free reserve? That reserve which is created out of revenue profit. Always free reserves are created out of revenue profits. And the money that you put in this reserve account, it is available for you to distribute as dividend to shareholders. That is called as free reserve. General reserve, you created. How? Whatever money is there in the P&L, a portion of it that you take and put in the general reserve. So from where it got created? Profit and loss account. So it is created out of revenue profits. And can I use this money for whatever purpose I want, including distribution of dividend? The answer is yes. Hence, this becomes my free reserves. Correct? So reserves are of two types. One is non-free reserves and free reserves. Correct? Reserves are of two types, general reserve and specific reserve. These both types are different. Third point, reserves are created either by the P&L out of revenue profits or by the balance sheet out of capital profits. So these are all different points. Can you put properly in your head organized? All the three are different compartment. So when I say free reserve and non-free reserve, free and non-free, from what point of view? Distribution of dividend point of view. When I say something is free reserve, instantly what should strike? Oh, I can give this money freely to anybody. There is no restriction on that. That is free reserve. Non-free reserve means what? That reserve comes with restriction. I cannot use that money freely. I cannot give it as distribution of dividend. So free reserve, non-free reserve are able to fix in your mind. When I say general and specific reserve, what should strike you in mind? General reserve means I can use it for whatever purpose I want. Specific purpose means only for that purpose and not for any other purpose. When I say reserve created out of revenue, profit, and capital profit, are you able to understand what example you should take? So all the 3 points what I discussed are 3 different compartments having 3 different meaning. So the moment I talk about it, you have to go only to that compartment to collect your concepts. Yes. No, that is what I'm telling you. General specific is different. Free and non-free is different. Free and non-free is from the point of view of distribution of dividend. Yes. General and specific means what? For example, WCR, it's a specific reserve. But when this money is not utilized at the end of the life of the company, can I use it for the purpose of distribution of dividend? Yes, because law does not say whatever money you parked in WCR, you should give only for the workman compensation. Law does not say like that. Which means if the money is unutilized in WCR, you can use it for distribution of dividend. So it's a specific reserve, but it is actually a free reserve. Am I clear? So you have to understand independently. Then there's something called a surplus. Surplus is very different. Surplus means what? Whatever is the balance of the P&L ledger, whatever is the balance of the statement of P&L, that is called as surplus. Now, all these reserves and surplus people, how are we supposed to present in the financial statement? All of them have to be independently be prepared. How to prepare? Very simple. You can draw a column which says particulars. Under particulars, you can have all the types of reserves. Then their opening balances. Then their current year additions to increase reserves. Then current year transfer, subtraction to decrease the reserve. And finally will be closing balance. So opening balance plus addition minus subtraction is equal to closing balance. So for each and every reserve, you have to do this presentation. Now this is called as horizontal presentation. You can also opt for vertical presentation. Vertical presentation means what? For every type of reserve, you will have opening balance separately, additions separately, subtractions separately, and then finally you'll have the closing balance. Like that, you'll have this presentation for each and every reserve separately. This is called as vertical presentation. Both presentation are allowed. Am I loud and clear? Online people, am I loud and clear?
Yes, sir.
Yes, sir.
Yes,
Yes,
sir.
sir. Yes,
Share
sir.
application money pending allotment is the next point. No, sorry. Next point is money received against share warrant. Sorry. What is share warrant? What is share warrant? We have discussed this in last class. It is an instrument that has been issued by a company where the company promises to give you the shares after few years, that is on a determined date, predetermined date at the predetermined value. But the money of that you have to pay now. So you have to pay money now to the company, but the company will give you the shares in future. At what rate they will give you, on which date they will give you, they will promise you. But they'll not give you the shares now. So when they don't give you the shares now, but they take the money, in that case, when you're paying the money, you become a warrant holder. So you pay money to the company, and for acknowledgement, what does the company gives back? A document called as share warrant. In that case, you become a warrant holder. If you are a warrant holder, do you have the same right as that of a member? Like member has right to dividend on the profits. So if the dividend is declared, member will get dividend. Will you get dividend? No. Member has the voting right. As a warrant holder, do you have the voting right? No. For the money what you've paid, interest if you want, will the company give you interest? The answer is no. Then why the hell anybody should pay the money to the company? What am I getting in return, boss? You are getting at a price, you're getting the shares at that price which you cannot get it anywhere else. Which means if my shares are listed in stock exchange for 3,000 rupees, I'm going to give that share today for 2,000 or 2,500 rupees. So where the company is getting the money, at the same time, it is, a win-win for both of us, but I'm getting the money. At the same time, you're getting the price at the discounted value. You're getting the shares at the discounted value. That is one lucrative point for attracting the warrant holders. Otherwise, why should anybody invest in the warrant? So there should be some benefit for us. No, if I'm investing in warrant, there should be some benefit accruing to me. If it is only benefit for the company and not for me, then why would I give money to the company? So if I have to give money to the company, there should be some benefit. So this is the concept of share warrant, which is being discussed in depth in the last class. Then share application pending allotment. This is a scenario where somewhere in 28, 29, 30, 31 March, last 5-6 days of the financial year end, you receive the money. And you are sure to do the allotment. But as on 31st March, you have not done the allotment. And you don't have the intention to repay the money back also because you're going to allot after 2 days. In that case, this money, where should I park? The money will be parked in the bank account. Bank account debit, the money will go to your bank account. But but the corresponding entry is there. No, bank account debit to equity share application. Now this equity share application, where should I classify? Under this category, share application money pending allotment. So share application money means what? The money that is received against the share application. Money received by the company. Am I supposed to repay the money back? No. Why? Because the allotment is still pending, which means I'm going to confirm, give the shares to this fellow. But when? After 2 days. But in between, what is coming? End of the financial year. 27, 28, 29, you got the money. Okay, you are taking 5 days to allot the shares. So when will the allotment happen? 2nd April, 3rd April, or 4th April? In that case, the money which is there on 31st March, how will you show this information in your balance sheet? The user of financial statement, how should they interpret this money received? So this will be called as share application money pending allotment. I cannot put this under capital because allotment is not done. Only when allotment is done, what is the entry? Equity share application to equity share capital. So to put something in capital account, I should have allotted. Did I do the allotment? No. Hence, I had to create a separate category called as share application money pending allotment. Is the logic clear? Till this, we have discussed in the last class. Now, we'll be focusing on the next two important concepts, very, very important to understand the two types of external liabilities. 11th, we studied the two types of liabilities. One is internal liability, second is external liability. Internal liability means the money that the business owes to the owner. Because as per accounting entity concept, as per business entity concept, owner and the business is different. So now whatever money we have taken from the owner, we have to pay it back in future. So anything that I have to pay in future is liability. But this money I have to pay to the owner. Hence it is called as internal liability. The money that you owe, the money that you have to pay to external people is called as external liability. So in the previous class, we understood the two types of internal liability. Today we'll understand two types of external liability. First is the meaning of non-current liability. Second is the meaning of current liability. Are you all ready? Online people, are you all ready?
Yes,
Yes,
sir.
sir.
Coming back to your notes. Before you understand what is non-current liability, you have to understand what is current liability. A liability shall. You know what is the difference between the word may and shall? Yes.
May means optional, shall is compulsory.
You may give my pen back. Means what? If you want to give, you give. Others, don't give. That is the meaning of may. If I tell you, you shall give my pen back, means give my pen back at any cost. Shall means what? It's an order. You have to follow. No escape from it. May means what? May is always optional. Shall is compulsory. Now here a liability shall. Shall means what? Compulsory. Be classified as current liability when it satisfies any of the following criteria. There are 4 criteria mentioned. If any one of the criteria also is triggered, you have to classify that as current liability. Any problem? Okay. Can we see one by one? Here, first I'll discuss the point number A and the point number C. Sir, is this the definition which Pratik sir has created, invented? The answer is no. This is given by Schedule 3. In Google, go and type Schedule 3 format. Entire balance sheet format will come along with the explanatory notes. I've picked the data from there. This we have discussed already in 12 CBC. In your volume 3 TS Rival, we had something called as financial statement. In that also we discussed this extensively. Today also we're going to discuss this extensively. In fact, little bit more in detail. Listen to me very carefully. Very, very important point. If this is not understood in true spirit, you're not just screwed, you're royally screwed. So listen to me. Every single word is important. Liability is a current liability when it is expected, the word is expected to be settled in the company during the normal operating cycle period. So first you have to understand what is the meaning of expected. Second, you have to understand what is the meaning of normal operating cycle. Correct? Normal operating cycle. Forget normal. What is operating cycle? We'll first understand. So my question to all the people out there, what is operating cycle? One by one I'll come. Something, whatever you feel like. Sir, a cycle which is in operational conditions, sir, that is operating cycle. You can say nothing wrong in it. What is that? No. For what? கொஞ்சம்.
So we have invested in the business.
Correct.
Time taken for the cash to be converted into the returns. We have purchased raw materials to be converted into manufacturing.
Emotion புரிஞ்சது. Wordings has to be better, but emotion I understood. Okay. அக்கா நீங்க சும்மா guess operating cycle. What do you understand? So that whenever I ask question like this, people become vigilant. They'll not sleep. வந்து பயப்படுது ஐயோ அப்படின்றமா இவ்வளவு பயப்படாதமா எனக்கு பயமா இருக்கு சும்மா கெஸ் பண்ணுங்க அது வந்து கரண்ட் liability. I'm asking the meaning of operating cycle. What is the meaning of operating cycle? Ma'am? சும்மா See, when I ask question, if you're not able to answer, you feel like taking revenge, no? Then you ask me something which I don't know other than CA accounts. You can ask other than accounts. Then that time I'll not be able to answer, no? That time revenge taken. Deal over. Okay, ma? Purvi, yes.
So the time taken for the material, if the time span is less than 12 months, then 12 months is less.
Yeah, poda. She's telling some. Why operating cycle period is only for the manufacturer? Right? It cannot be for trader.
To yield until the product is sold in the market and
Very good. Understood emotion. Hari is like controlling from that time. So I want to say, you're not allowing me. Yes, Hari. You can go ahead. It's okay? Okay. Now listen, this is the operating cycle meaning given in the Schedule 3. The term operating cycle is defined in the Schedule 3 of Companies Act 2013 as follows. Operating cycle means the time between acquisition of assets. The time, say that focusing on the time period. Time period could be in days, months, anything. So for convenience sake, I'm taking months. The time between acquisition of assets for processing. So which assets do I acquire to process? Process means what? I want to manufacture raw material purchased, put through the manufacturing process. Put through the manufacturing process so that at the end of the manufacturing process, we get a new product with a distinct quality and feature, which has got its different consumption. That is called as processing. So the time between the acquisition of assets for processing and their realization in cash and cash equivalent is called as operating cycle. With this, you will not understand anything. I have to explain for that. First, from the point of view of the manufacturer. Okay, all of you are manufacturer. Imagine all of you are entrepreneur. Let's suppose we want to manufacture furnitures. So for that, what do you need? So we need wood. So for buying wood, what do you need first? Sir, paisa, sir. Money. Duddu. Tamil le sollana. Correct? Okay. Your Zoom account is being signed to in another device. Bye, man. Online people, are you all able to hear me?
Yes, sir.
Yes, sir.
Yes, sir.
Now, if I want to start the manufacturing of the, let's say, furniture, for that I need wood. To buy wood, that is raw material, I need money. So there is my starting point. Cash and cash equivalent. What is cash and cash equivalent? Money. Now, I have purchased the raw material. Now, is it necessary that whatever raw material I buy, the same day it should go for production purpose? Not required. 2 months my labor did not come, staff did not come, the production did not begin. So this raw material was lying in my warehouse for 2 months for idle period. So that is called as raw material holding period. What is it called as? Raw material holding period. So here, I had the raw material in my godown for 2 months. Okay. So I invested the money in the raw material, and the raw material was lying idle in my godown for how many months? 2 months. Then what happened? I sent this raw material for manufacturing purposes. My production department took 1 month to process the entire furniture because the furniture was that big. It took 1 month to process the furniture. Processing period 1 month. Any problem? Online people, processing, do you understand what is processing?
Yes, sir.
Okay.
Yes.
My team has taken 1 month to do the processing. Then the goods were processed. This goods which is processed, manufactured, they have kept in the godown as a finished goods. And my team took 2 months to sell the product. So how many months was this furniture lying in my godown idle? 2 months. Then what happened? After 2 months, my sale team, sold this furniture to a debtor on credit. And the customer agreed to give that money back after how many? How many months? 3 months. After 3 months, the person said, I'll give you the money back. So I sold these goods to debtor on credit, where he said that, sir, I'll pay this money back after 3 months. So after 3 months only, this money is going to come back to me. Which means the money which I invested today, how long it took to come back in form of money? The money I invested today in form of raw material, it traveled slowly like this in circle, and again it is coming back to me in form of money because the debtor is going to give me money in cash. So cash went out, and again this cash is coming back again. After how many months?
3 months.
2 months plus 1 month is 3 months, plus 2 months is 5 months, plus 3 months is 8 months. So 8 months we are taking to get the money back, right? So this is called as operating cycle period. This cycle is called as, that is from cash stage to coming back to cash stage. Starting from cash stage to coming back to cash stage, this entire cycle is called as operating cycle. Means in my business, this is how the normal operating period is. In my business, this is my operating cycle. This is how I start the business with cash. This is how I buy the raw material. Normally in my business, the raw material is lying for 2 months ideally. This is true. My people take 1 month to process. My people take 2 months to sell. My people take 3 months to recover money from debtors. This is normally happening in my business. Hence, it is called as normal operating cycle. And this period is called as normal operating cycle period. So, what is operating cycle for my business? 8 months. So, I will understand what is operating cycle. Online people, tell me please. Are you able to understand what is the operating cycle and what is operating cycle period?
Yes, sir.
Yes, sir.
In case of manufacturing business, trading business, what happens? In trading business, this stage is skipped. Raw material stage is skipped. Processing stage is skipped. You directly buy the goods. So you buy the goods. How many months you keep that in your godown? Then you sell it to customer. How many months do you take to get it back from the customer? So only 2 stages you have in the trading. So for trader, 2 cycle. Two process in between. That is also called as operating cycle period for the trader. Do you understand what is this? All in people, hello.
Yes, sir.
Now let's come back and read this one more time. Operating cycle means the time between. Here the time is measured in what times, what units? Months. Very good. Between acquisition of asset. Which asset are we talking about? Raw material or stock in trade? Raw material for the manufacturer. Stock in trade for the trader. For processing means selling the purpose, and the realization of the cash and cash equivalent. It starts from buying the raw material, ends with getting the money back in form of cash from the debtor. Correct? No? Here we started with buying of the raw material. And where did we end? Collection from the debtor. This entire cycle is called as operating cycle. Am I loud and clear? When normal operating cycle cannot be identified in any business because we do multiple products. Each product has got multiple operating cycle. In that period, you cannot, or in that case, you cannot assume a normal operating cycle period. So in that case, the standard assumption is what? 12 months. In any business, if I cannot calculate, if in any business, I cannot calculate my independent operating cycle period, we assume that our operating cycle period is 12 months. Correct? Now, can any business have operating cycle period more than 12 months? Can I say that there are certain businesses which has the operating cycle period beyond 12 months? So which type of company? So let's suppose, yes, I am into either manufacturing of big ship, which is also called as vessels. Vessels means what? Big cargo ships is called as vessels. Or I'm into the process of manufacturing the aircraft. Imagine, no, how many types of raw material I have to buy. When I put an order, some products come to me in form of raw material. It will take multiple months. Let's suppose I'm manufacturing aircraft. So I want aircraft engine. So I will order that aircraft engine to somebody. So that is raw material for me for assembling purposes. So when I order the aircraft engine, I take 3 months to get the aircraft engine. Like that, different components will come to me in different months. So until then, whatever raw material I have accumulated, I have to keep that everything idle in the godown. Correct? So that will take how much? 3 months, 5 months, 6 months also it will take for me to raw material to get. To get raw material, sometimes we get even 6 months. Then once all the raw material for the aircraft comes, what do? We start assembling, because we don't do manufacturing there. There's a difference between manufacturing and assembling. Manufacturing means what? Manufacturing means what?
From the scratch we will produce.
Yes.
Maybe we change the characteristic.
You mix the component and you're not able to identify the components independently. That is manufacturing. For example, when I manufacture a cake, you put all the ingredients that we call as manufacturing. After the cake is baked, can you say this is baking soda, this is wheat flour separately? You cannot segregate the components. That is manufacturing. Assembling means what? The same component is attached. We can identify separately. You can piece a culture. That is called as assembling. So aircraft is assembled. So people take 3 months, 4 months, 5 months to do the assembling process. Correct? No. So 6 months raw material in a go down. 6 months for assembling. Then 6 months for selling it, or 3 months for selling it, let's suppose. So 6 plus 6 is how much? 12. Plus 3 is how much? 15 months. Then once you sold it, the person will not give you the money on spot, because aircraft value is very big. 3 crores, 5 crores, 10 crores. In that case, the opposite person will give me the money gradually. So the money that is coming back to me is taking another, let's say 6 months. So 15 months plus 6 months is how much? 21 months. So in my business, what is operating cycle period? 21 months. So this is a classic example where we can say that the operating cycle for a business, the operating cycle period for a business could be beyond 12 months also. If nothing mentioned, the operating cycle period is how much? 12 months. If you're not accepting 12 months, then you have to show your operating cycle period, which could be beyond 12 months. Any problem in this? Online people, any problem in this?
No, sir.
No, sir.
Once again, let me complete this kana or flow lo mudichirren. Where is it? Here. So they're telling that a liability shall be classified as current liability if it is expected to be settled in the company's normal operating cycle period. Okay. Which means what? In my business, if the operating cycle period is 13 months, now how do you calculate? Here, I have purchased one goods from creditor. Okay. 1 lakh rupees. Okay. Now, we are preparing the financial statement for this financial year. We are into now which financial year? 24-25. Means my end of the financial year is how much? 31st March 25. Now, when I'm preparing the balance sheet, yes, when I'm preparing the balance sheet here on 31st March 25, the question mark is that this 1 lakh, will you classify this as current liability or non-current liability? So you have to ask yourself a few questions here. This 1 lakh, when are you going to pay? If the answer is somewhere next year itself, then this will become current liability. How? You have to ask yourself a question. You have to calculate from 31st March 25. This 31st March 25 is called as reporting date. What is it called as? Reporting date. Now, I have not taught you the point number C yet. I have only taught you point number A. In that case, what is your operating cycle period? Let's say your operating cycle period is coming out to be 12 months. Operating cycle period is 12 months. So from the date of balance sheet, from the balance sheet date, you're supposed to calculate how many months? 12 months. So we calculate 12 months. Where does it goes and ends? 31st March 26 is the date when your operating cycle period ends. That is from the reporting date. From the reporting date, you have to calculate operating cycle period. What is operating cycle period? We have calculated 12 months. This we will call as benchmark date. Is the word benchmark date given by a company law? Is this given by Schedule 3? Is this given by accounting standard? No. Benchmark date is my invention for our understanding purpose. So what is the first step? First step is calculate your operating cycle period. Second step, apply that operating cycle period on this date. You will arrive on date called as benchmark date. 2 steps done. Third step, you have to ask yourself, am I going to make the payment? on or before the benchmark date or after the benchmark date. What will you ask? You have to ask third question. Will I make the payment or the company will the company make payment? Will the company make the payment on or before benchmark date or after benchmark date? I said you that the payment is going to happen here. So is the payment going to happen on or before the benchmark date or after the benchmark date? On or before the benchmark date. Before this, the payment is going to happen. Therefore, I have to classify this 1 lakh as now current liability. Where in the current liability we'll discuss eventually. As of now, where will I classify? In current liability. Now, what is the language saying? Liability shall be classified as current liability if it is expected, if the creditor in our example is expected to be settled in the company's normal operating cycle period. So can I say this 12 month is the normal operating cycle period? In this period, are you going to settle the money or not? The answer is yes. Then this liability today becomes my current liability. I mean, this is the money that I'm going to pay within next 1 year. Why do I want to classify this as current liability? Why? Because this 1 lakh rupees is the money that I have to go and pay next 1 year or within 1 year I have to pay. I need to arrange money, no? So when I classify a liability as current and non-current, current means what? Any money that I'm going to pay next 1 year approximately is called as current liability. So if there is any money that I have to pay next 1 year, I have to run very fast to arrange the funds for paying the money. Whereas if there is any non-current liability, means what? If any liability I have to pay after 1 year, after 2 year, after 3 year, I can relax. Slowly I can arrange the money. But the money that I have to pay next 1 year, I have to run fast to arrange the money. That is why the liability was supposed to be segregated into 2 parts. Current liability it is nothing but urgent liability. Means what? The money that I have to pay next 1 year is called as current liability. So I have to urgently run around to arrange the money funds. Non-current liability means what? A liability where there is no urgency to pay the money. You can pay arams after 1 year, after 2 year, after 3 years. So you have time to arrange the money to pay the liability. So hence it is important for me as a owner to know what is my current liability and what is my non-current liability. If you say something is current liability, I have to run and arrange the funds for it. If I don't arrange the money, if I don't make the payment to the creditor on time, next time will the creditor trust me and give the goods on credit? No. Hence, it is very important for me to segregate the liability into 2 types. And the liability which is current, which is urgent, I have to make the payment on time as promised. Before entering into contract, before you buy the goods, you want to argue with him for credit period, you argue. He's telling, I'll give you 1 month credit. You bargain for 2 months credit, 3 months credit, no problem. But once you agree that after 3 months I will pay, on the due date, you have to honor your commitment. Then you're a true businessman. If you do not make the payment on the committed date, the people will never trust you and give you the item. Am I loud and clear? Online people, am I loud and clear?
Yes, sir.
Now, point number B, we'll keep on hold. Let's come to point number C. A liability shall be classified as current liability if it is due. The first line is expected. What is the meaning of due and expected? We'll discuss. Big mosquito. Now, it is due to be settled. It is due to be settled within 12 months after the reporting date. Okay? Now, for this, I would like to take one practical question. Before that, I have an example for all of you. Example number 6. You can take a pic of this if you want. A nice, interesting question. It says that this particular company is having a raw material holding period of 6 months. So basically, this is a manufacturing company, is into manufacturing of some product. This company is buying the raw material, and the raw material is there in their godown without processing for how many months? 6 months. So raw material holding period, which means in my business, I'm holding the raw material for how many months? 6 months at any point of time. My raw material is lying idle for 6 months. Okay. Which means the money that I've invested in the raw material is blocked for how many months? 6 months. Then work in progress holding period means my company is taking 2 months of time to process the item. The finished goods is taking 2 months to process. Okay. Once the finished good is processed, my people, staff is holding that FG in the warehouse for how many months? For 3 months, which means 3 months the goods are lying idle in the godown without being sold. So again, my money is blocked for how many further months? 3 more months. Then I've sold the product and my customers are paying me the money only after 3 months. So debt or collection period. I'm taking 3 months to get that money back, which means my money, my funds is blocked for how many months? Again, further 3 months. So all this put together is how many months? 14 months. And this 14 months is called as what? Operating cycle period. Means the time taken for my cash to be converted into raw material, FG, debtor, and coming back as in form of cash. This entire time period is called as operating cycle period. Are you able to understand? Compute the operating cycle period of KVA Limited from the above information. Compute the operating cycle period. How do we calculate? The operating cycle period of KVA Limited is computed as follows. Raw material holding period plus WIP holding period plus FG holding period plus debtor collection period. So all put together how many months? 14 months. Any objection? Online people, any objection?
No, sir.
Now, second point. Classify the trade payable. Means in this question, what is the underlying liability? In the business, there could be multiple liability. No, here we are focusing on which liability? Trade payable liability. Classify the trade payable in the financial statement. Trade payable means what? I would have purchased this raw material on credit. No? I would have purchased the raw material on credit, so I have to pay the money. So that gentleman, I'm paying the money when? If the payment is expected to be settled in 13 months. The payment is expected to be settled in 13 months. Then this trade payable will be classified as current or non-current. Can we say? Let's say the trade payable is 1 lakh rupees. Okay. Let's say the trade payable is 1 lakh. Don't do anything, just observe. Don't do anything, just observe. We are into which financial year? 24, 25. Somewhere here, people. 1st March 25. We have purchased the raw material. We have purchased the raw material. So I am supposed to make the payment. Do you agree with me? Now, this is what date? 31st March 25. I have to make the balance sheet. I have to prepare the balance sheet. This raw material I have purchased for 1 lakh rupees. I have agreed for a credit period where I have to settle this within 13 months. Within 13 months of operating cycle period. Okay. Now, as on the balance sheet date, can I say the payment is not done? Because the payment operating cycle period is how much? The trade payable is expected to be settled in 13 months, which means definitely by 31st March, I'm not going to pay the money. Do you agree with me? By 31st March, I'm not going to pay the money, which means I'm going to pay the money in future. Anything that I'll pay in future is liability. Now, the $1 million question here is that this liability is current liability or non-current liability. So I'm putting in the balance sheet on the liability side 1 lakh rupees. Now we have to understand the classification of this 1 lakh, whether it is going to be current liability or non-current liability. Now for this, you have to follow some step. What will I do? I will open the next year. I have to open the next year. Point number A says that you have to calculate the operating cycle period. Means what? The liability, if it is expected to be paid within the operating cycle period, then it is current liability. So what is my operating cycle period? 14 months. Trade payable means yes. Trade payable means what? The money that I have to pay to my trade payable is nothing but sum total of creditor and bills payable. Creditor means what? I've purchased the goods on credit and I have to make the payment to creditor. So that is trade payable. Clear? Now, point number C says what? A liability will be classified as current liability if it is due to be settled within 12 months of reporting date. 12 months of standard operating cycle is 12 months of reporting date. Point. Are you clear with this point? There are 2 points. Always take higher of these two. Always take higher of these two. Higher of A and B. So which period is higher? 14 or 12? It is 14 months. So your benchmark date is going to be 14 months. 14 months from when? 14 months from, wait, 14 months from point number 1 or 14 months will you calculate from point number 2?
Point number 2.
See, 14 months calculate panno. You have to calculate 14 months. Will you calculate 14 months, 1, 2, 3 from date number 1 or will you calculate from date number 2? If you say date number 1, imagine in a year, from how many percent will you buy the goods? At different dates you buy the goods. Imagine you are a manufacturer who's buying this raw material 10 times in a month. 10 times in a month. So in a year, how many times will you purchase? 120 times. So are you trying to tell me from the respective purchase date, I'll keep on calculating one by one? As auditor, I have no other work. As an accountant, I have no other work. That for every single item from that date, I'll calculate 120 days or 12 months, 10 months, 13 months. You'll go mad. So for simplicity purpose, what they said is, whatever the benchmark date month you're getting here, no benchmark month, always calculate from the balance sheet date. From here you calculate, it becomes easy because as on 31st March only we have to classify this as current or non-current. When I should classify this as current or non-current? On 31st March. From that day you have to calculate this 14 months. So if I calculate 14 months from here, when does my benchmark date ends? If I calculate 14 months from here, starts like this. 12 months gets over here. 13 month here, 14 month here. So which means what? 30 or 31? Sorry, 31 May. 31 May 2026 or 7 now? Hey, 6 only, no? 1, 4, 25. Confusing me also. 31, 3, 26. This is 1, 4, 26. Guys, let's suppose I'm sitting on 31st March 25. I want to travel to space. How many months will I take? Space, ma. Space. NASA, space. She got computer people, commerce people. Space means keyboard space, they'll think. Because immediately that NASA will not connect to the commerce people. No. I'm talking about NASA, scientist, ISRO. That space I'm talking about. Where everything is black. People fly. That space. So imagine Pratik sir is starting the journey today, 31st March 25. Pratik sir will take how many months to reach? 14 months to reach to the space. Imagine what is wrong in imagination. My question is, what is the due date on when which I will land on the space? Forget space. Moon sir is traveling on moon. Come, forget space. What is there in space? Nothing is there. Moon means at least people will have my name in the history. Second person, third person, fourth person to land on moon. Ilya, she's getting, sir. Moon la land aram Pratik sir. Okay, wow. If I start today, I'll take 14 months to land on moon. What is the due date on which I land on the moon? 14 months from now. 31st March 25 to 14 months if I travel forward. So 12 months gets over here. 12 months will get over here. And another 2 months means 31st May 26, I will land on moon. Correct? Like that you have to land in the question also. This date is called as landing date. And for us, this is called as benchmark date. What date is called as benchmark date? Is the word benchmark date there anywhere in the Schedule 3 Companies Act? Will any other academy teach benchmark date? It is our language to understand the complicated problem in the simplified manner. Now, can I call 31st May as benchmark date? First step, what did I do? First step, I calculated my operating cycle period or standard operating cycle period, whichever is higher. First step. Correct? Second step, I calculated my benchmark date. Third, you have to ask yourself a question. Am I going to make the payment on or before the benchmark date? On the benchmark date means when? 31st May. Before the benchmark date means where? Anywhere here. If I'm making the payment, this is called as current liability. If I'm making the payment beyond the benchmark date, it is called as non-current liability. Now, please tell me, when am I going to make the payment? Sir, the liability is expected to be settled in 13 months. 13 months from where? 13 months from the balance sheet date I'm going to make the payment. Not 13 months from 1 March 25. Always the payment will be calculated from the reporting date. So please tell me, 31st March 25 is the reporting date. I take 13 months to pay the money. That is, I'll be either paying on 13th month or before 13th month. One second, I'm coming. Karna, we are preparing the current and non-current liability classification on for which date? Reporting date, no, which is 31st March. So everything, all the drama, what we're doing is on the reporting date or for the yes, it doesn't matter when the creditor is actually triggered, because if we start calculating this data from the date of the transaction, in a year you'll do 10 transaction, 30 transaction, 100 transaction. For each transaction we start calculating like this. You have no other job or what?
Sir, if any transaction between 24, 25, the starting reporting
yes,
will be
very simple. See, whatever transaction can happen here. at the end of the year, on the reporting date, if this liability is still pending for payment or not, the answer is yes. The amount is still pending to be paid. Then you have to apply these steps. Am I loud and clear? Now, I am going to make the payment within the benchmark date. Am I right? Because the benchmark date is after 14 months. I am making the payment within 14 months. Within 14 months is when 13 month. That is 13th month. Somewhere 30 April itself, I am going to make the payment. The payment is going to happen within the benchmark date. The payment is going to happen within the benchmark date, which means I should classify this 1 lakh as current liability. Online people are able to follow.
Yes, sir.
Yes, sir.
Yes, sir.
So now, since the operating cycle period is 14 months, operating cycle period, that is 12 months or 14 months, which is higher? Which is higher? 14 months is higher. And the trade payable is expected to be settled within 13 months. That is in 13 months, which is within 14 months. It should be classified as current liability. Since the operating cycle period is 14 months and the trade payable is expected to be settled in 13 months, which is coming within 14 months, and hence this will be classified as current liability. Any problem? Second question. Classify the trade payable in the financial statement if the payment is expected to be settled in 14 months. Current liability means what? Any liability which will be settled on or before the benchmark date. What is the benchmark date? 14th month is the benchmark date. 13th month is before the benchmark date. So whether it is 13 or 14, any payment done on or before the benchmark date is going to be my current liability. So second question also the answer is what? Third question also it is current liability. Since the operating cycle period is 14 months and the trade payable is expected to be settled in 14 months on or before the benchmark date, hence it should be classified as current liability. Fourth one, classify the trade payable in the financial statement if the payment is expected to be settled in 15 months. Means beyond the benchmark date. What is my benchmark date? 14th month is the benchmark date. But you are making the payment after 14 months, beyond benchmark date. Hence now this 1 lakh is becoming my non-current liability. Means I still have time to arrange the money. There is no urgency for this 1 lakh rupees. I have to make money arrangement for other current liabilities. I can take some good time to make arrangement for this funds. I can be relaxed. When I say something is non-current liability, I can be relaxed. Since the operating cycle period is 14 months and the trade payable is expected to be settled in 15 months, which is beyond the benchmark date, it should be classified as non-current liability. Any problem?
Sir, I have a doubt, sir. Could you go to the example?
Whiteboard?
Yes, sir. Sir, that's 1/3/25, sir.
1/3/25 is the date on which the raw material has been procured. Okay.
From that to 31/5/26, 15 months.
From here to 31st March 26, we cannot calculate because if you start calculating from this date onwards, then what will happen? For each and every transaction, can you sit and calculate? Let's suppose on 31st March 25, you are supposed to make payment to 50 different parties. And these 50 different parties have given the raw material to you or some goods to you at different points. Are you trying and telling me that for these 50 people, I shouldn't calculate this benchmark date separately? You'll go mad. We don't have any other work. If Schedule 3 imposes that kind of implications, then nobody will follow Schedule 3. See, as a lawmaker, you have to make the law to ensure your data is transparent, understandable, reliable. I agree. But that should not be at the cost of harassing somebody. So if I start calculating from the independent date, it is a harassment, boss. Then nobody will follow this disclosure. People will say get lost in this disclosure and nobody will follow. Then this law what you're trying to bring in is going to be total failure. Long no. At the same time, it should be also practical to be imposed. Hence, they said for convenience purpose, calculate all this benchmark date from the reporting date. So from the reporting date, one shot benchmark date. Am I paying the money on or before the benchmark date? If yes, current liability. If I'm making the payment after the benchmark date, it is non-current liability. Very simple, no? We should not complicate too much. See, as a owner, I just want to understand what money I have to arrange urgently and what money I can take some time to arrange. So for that, they try to come out with a simplified model. This is the best that they could have thought about it. Am I loud and clear? Online people. What you are saying, Kritan, that is also possible. You want to try to calculate from the respective date of raw material purchased from the creditor triggering date. You can do it. Nobody can stop.
But for the creditor, how I agree, sir? I'll tell the creditor your credit period starts from 31/3/20.
No, correct. From 1st March, it agrees. See, though your credit period calculation begins from 1 March, இப்போ நான் வந்து ஒரு creditor, I have given the goods to you on 1 March. So I will calculate the credit period when from 1 March only. But using that date, what are you arriving? Payment date. So what am I focusing here on? I'm focusing on two things. One is what is my benchmark date. Second, my payment date. If the payment is happening within the benchmark date, current liability. The payment is happening beyond the benchmark date, non-current liability. See, please understand. When I'm calculating the payment date, due date, I'll calculate always from the date of purchase of the raw material. From the credit purchase date only, I'll calculate the payment period. See, for the creditor, he's not bothered about my reporting date. For creditor, what happens? He says that, look, boss, I gave you the goods on 1st March. Now, one and the goods there. Above 1 March. 3 months credit period. Means when? March, April, May. May, you have to pay me the money. So, what is my payment date? May. So, due date, you will calculate from the actual purchase date only. I'm not telling no. But for the purpose of calculating current liability, what is important? First thing, I should be clear with my benchmark date. I got my benchmark date. Second question, am I making the payment within the benchmark date or beyond the benchmark date? On or before the benchmark date, current liability. After the benchmark date, non-current liability. Very simple.
So in this example, the payment date, sir, 1-3 from here to 15 months if we take, sir.
I have example based on this. You just give me one more question. I have one more question. I have one more question here. Based on this, we'll again try to understand. Online people, are you all ready? Can we do it?
Yes, sir.
Yes,
Yes,
energy.
sir.
No energy. Online people. Everybody.
Previous question.
Yes, sir.
Yes, sir.
Yes, sir.
We got the line. Like in the question.
Which you're talking about, operating cycle period.
No, like
Can you help me with this question? You can ask the doubt here. Either relate panni company ma? Ilya. Okay, he wants to go with previous question. 1 second. Classify the trade payable in the financial statement if the payment is expected to be settled within 15 months. 15 months always I told you from the balance sheet date. Expected to be settled within 15 months of the reporting date. This is to understand whether the payment is falling where. So I'll calculate 15 months from the reporting date. I'll take the same question. You'll understand because this question has got multiple numericals. So with this, you'll understand better. I'll do all the 5 questions with you together. Now, classify the liabilities which is trade payable given below as non-current liability or the current liability, giving reasons for such classification. Okay, wow. Now, trade payable is the liability which I have to settle. Imagine this is 1 lakh rupees. How much? 1 lakh rupees. Operating cycle in months is given. This is your standard operating cycle or it is calculated operating cycle. This is calculated operating cycle, which is you have properly calculated your operating cycle. That is, I invested money today and I got the money back after how many months? 10 months. 10 months. So this is calculated operating cycle period. So what is your standard operating cycle period? Standard operating cycle period is 12 months. So can I put 12 months, 12 months, 12 months, 12 months, 12 months? Once again, let me complete. Now, expected payment period in months is what? 8 months. Expected period is 8 months. 8 months from respective due date. No, respective. That is if I have taken the goods on 1st March. From 1st March, 8 months. I'm coming one by one. Expected payment in months is 8 months. Now clear. Now you have to classify whether this 1 lakh what I'm going to pay on 31st March onwards, is this current liability or non-current liability? I'm putting this data on the table, on the whiteboard. Please understand carefully. One by one we'll do. Now let's say this data is for the financial year 24-25. Means what is our reporting date? So this is my reporting date, 31st March 25. So when I'm preparing the balance sheet here, this 1 lakh rupees trade payable is there. No, I have to classify whether this is current or non-current. Am I clear? This is the question here. So for that, what is my step 1? Step 1. Calculate operating cycle. That is standard operating cycle or normal operating cycle, whichever is higher. I'm giving you step 1 by 1. Okay, wow. Second, step 2. Apply step 1 from the reporting date and arrive at benchmark date. End step panninga. What is step 1? Calculate your standard operating cycle, which is how much? 12 months. Standard is always 12 months. Normal operating cycle period means what you are calculating. In this, what will you take? Higher. So can I go to that part now? So now, particulars, amount involved. So what is a liability nature? Sorry, what is a liability type, which is trade payable? What is the amount? 1 lakh rupees. Now please tell me in this, what is the standard operating cycle? Standard operating cycle period. 12 months. Online people, what is a normal operating cycle period? It is given
10
in the
months.
question 10 months. So what is your benchmark month? In this, whichever is higher, you have to take higher of these both. So what is a benchmark month? 12 months. Correct. So step one, what did you say? Calculate standard operating cycle period or the normal operating cycle period, whichever is higher. So step one, did I complete? Yes. What is step two now? Whatever data you got from step one, apply that from the reporting date. So from the reporting date, calculate that month and arrive at what? Benchmark date. Arrive at the benchmark date. Now, this 12 month, I have to apply from what date? Benchmark date. So from here, I have to apply 12 months. Please tell me, if I start traveling here from this date, when does my 12 months ends?
31st March 26.
31st March 26 is the day when I land after or on the benchmark date. The benchmark date will be landed by me on 31st March 26. So can I call this as benchmark date? Yes. Now, step 3. Ascertain the date of payment or due date of payment. When am I going to make the payment? Get me that date now. So now the payment, the expected payment period is how much? 8 months. They never said due date. Expected means what? It can be settled anywhere in the 8 months of the balance sheet date. Adavade, when I say expected means what? From the due date, anywhere here within 8 months, it could be settled. That is why the word is expected. Had they said the word due date here, then the due date should be calculated from the date of the purchase of the goods on credit. I purchased the goods on 1st March 25. This is the date of purchase. So when I apply the due date here, I'll apply the due date from the date of purchase. Correct? Have they given here the due date? No, it is expected period. So when I don't know what is my date of purchase, when I don't know what is my credit period, how will I calculate the payment period from the date of purchase? Is the data available here? Not available. So what is my second best option available? I will calculate that from the reporting date. I will calculate from the reporting date. Correct? So from the reporting date, I'm applying how many months? 8 months. Expected payment period is 8 months from reporting date. So either you calculate from the reporting date or you calculate from the date of purchase. In the question, if the date of purchase is given, if the due date is given, then calculate the date of payment accordingly, like how we did in the CA Foundation. Tell me which topic? Calculation of the due date, bills payable. There's a topic called as bills payable. In that, we learn how to calculate the due date. So due date is calculated from the transaction date plus 3 grace days. You remember? No, grace days you forget here. So due date means what? It is from the date of transaction. So what is the date of transaction here? 1 March is date of transaction. In the question, have they given you the date of transaction? No. In the question, have they given you the credit period? No. Then how the hell will I calculate the payment period from 1st of March? Not possible. Data is not there. Correct? I have to get the payment date. Okay, wow. Ending pay panna the date I want. So either you calculate from the date of purchase if the question is having sufficient information. Otherwise, calculate that from the end of the financial year, which is reporting date. So what data is available here? Reporting date. So from 31st March 25, 8 months if I calculate, where will I land? Guys, they're telling that the payment is expected to happen anywhere in 8 months of the reporting date. So from here, please calculate 8 months and tell me on which date I'm going to make the payment. April, May, June, July, August, September, October, November. 30 November 2025 is the expected payment date. Okay, ba? So what is my step 3? Ascertain the date of payment. Ascertain the date of payment. Calculate the date of payment. Calculate or not calculated? Calculated. What is my step 4? Check if the payment is happening on or before benchmark date. Check the payment is happening on or before benchmark date. Yes. If the payment is happening on or before benchmark date, it is my current liability. No, the payment is happening beyond the benchmark date. That is my non-current liability. Check now whether the payment is happening on or before the benchmark date. Come back and see. When is the payment happening? So the payment is happening before the benchmark date. Before the benchmark date. So now this payment will be classified as current liability because this money I have to arrange in next 8 months. I have to pay the money in next 8 months. So I have to urgently arrange money. So this is my current liability. So I'll classify this as current liability. Classification, current liability. Any problem? So the classification is current liability. How? You have to calculate your standard operating cycle period or the normal operating cycle period, whichever is higher. So that becomes your benchmark date. Am I making the payment within the benchmark date? The answer is yes. Within benchmark date, I'm making the payment. 8 comes before 12. Expected payment period is on or before the benchmark date. And then this is my current liability. Is the logic clear or not clear? Online people, please tell me. The logic is clear or not clear?
Clear,
Clear,
sir.
sir.
Clear, sir.
Let's apply the second question.
So what will the tablet columns,
Tableau column name,
particular class, case,
case classification. Anyways, I'll be giving this PDF to you. Don't worry. Can I do the next question, people? Online people, hello?
Yes, sir.
Now, second question, trade payable, same 1 lakh rupees. Operating cycle is 10 months. Standard operating cycle, 12 months. In this, which is higher? 12 months. So that becomes benchmark month. Expected period, payment period is 12 months. So what do you think this is? Current liability.
Current liability.
So what is step 1? Calculate your standard operating cycle period or normal operating cycle period, whichever is higher. So in this, which is higher? 12 months is higher. So what is step 2? Apply the 12 months from the reporting date. So you will arrive at what? Benchmark date or benchmark month. So from here, if I calculate 12 months, please tell me what is my benchmark date?
31/3/26.
31/3/26 is the benchmark date. Next, I have to calculate the date of payment, month of payment. Payment is going to happen within 12 months of what? If the due date is not given, if the date of transaction is not given, then I have to calculate this 12 months from the reporting date. So what is my reporting date? 31/3/25 is the reporting date. So from here, if I calculate 12 months, my date of payment is also happens to be same 31st March 26. Fourth step, check whether the payment is happening on or before the benchmark date. Here the payment is happening on the benchmark date. And this is my current liability. Hence, this is my current liability. It is current liability. Expected payment period is on or before the benchmark date. It is on the benchmark date. And hence, it is my current liability. Now, you may ask a question. So, what if this person does not pay the money, sir? I'm not bothered about what he's doing in future. Today, when I'm sitting, has he defaulted the payment? No. Future, after 1 year, if he defaults the payment, that time we will see what to do. Today, I know that he's going to make the payment. So I'm believing that he'll make the payment. So we cannot, predict, no. We are not nannies that, okay, we'll predict, okay, on 12th March, this guy will not pay the payment. Hence, I should classify this as non-current liability. No. What does law says? From here, what vision you have, what clarity you are getting. Based on that, we are doing the assessment. His intention of default, there, not there, we don't know. We are not bothered about his intention of default. Today, what is the date of payment? When is the payment happening? Within 1 year or not? That is a $1 million question. Am I loud and clear? Next point. Let's see how many of you can understand this. Trade payable people say same 1 lakh rupees. Standard period is 12 months. Normal is 10 months. In this, which is higher? 12 months is higher. This is step 1. What is step 1? Calculate your standard or normal, whichever is higher. So what is the benchmark month? 12 months. Second step is apply this 12 months from the reporting date. So if I calculate this from the reporting date, my benchmark date is supposed to be what? 31st March 26. Online people, do you all agree with me?
Yes, sir.
Yes.
Okay.
Yes, sir.
Third step is what? calculate your date of payment. Date of payment can be calculated either from the transaction date or from reporting date. Transaction date is available? No. Due date is available? No. So I have to calculate 15 months from the date of reporting date. So now, if I calculate 15 months from the reporting date, what is my date of payment? 15 months I have to calculate.
31/6.
If I calculate 15 months from here, the payment is happening somewhere in the next to next year. Where? 30 June 2026. How, sir? 12 months of the next year and 3 months of next to next year. 12 plus 3 is how much? 15 months. 15th month is getting over on 30 June 26. So this is my date of payment. Third question is, or third step is, arrive at your date of payment. What is fourth step? Check whether the date of payment is on or before the benchmark date or after benchmark date. So here the payment is after benchmark date. Hence this becomes my non-current liability.
Non-current liability.
Non-current liability. Expected payment period is beyond the benchmark date. Hence this becomes a non-current liability. Now the maja is coming. Once you understand concept and the step-by-step procedure, you'll have fun in your life, I'm telling you. This stands good for all the subject. So understanding is very, very essential. Can we do next one? Online people, no Josh. Online people, no Josh. Are you all there?
Yes,
Yes,
sir.
sir. We are there.
Akshara, Dharmi, Pawan, Harini, Jeevika, Lakshita, Reshma, Rudra, Sumanyu, Vignesh, Yash. Good evening. Hello. So sorry.
Good evening.
Just woken up from the sleep. No, so good morning is the right word. Good morning. Say no good morning back to me. Poor fellow. Online people, are you all there?
Yes, sir.
Yes, sir.
Yes, sir.
Fourth question, trade payable. I have to pay 1 lakh rupees in the future. So I have to classify this as liability. But I'm confused whether it is current or non-current. Can you all help me? Because all of you are CA. You should believe that you are a CA. No, sir, I'm a CA student. I'm a CA. Every day when you get up in the morning, add CA to your name. With that vision, if you get up, one day if you don't become CA, or if you are going away from becoming CA, you'll be restless. You cannot be without it. So you will try for it. You will work hard for it. You will slog for it. So imagine you are a CA. So my dear CAs, please tell me the operating cycle period of my business. The normal operating cycle period is 18 months. What is standard? 12 months.
12 months.
Which is higher? 18 months. Very good. So now step 1 is calculating the operating cycle period normal or the standard, which is higher. Second, apply this date from the reporting date or the balance sheet date. So if I apply this date from the balance sheet date, I'll do a new one itself. So this is 1, this is 2, this is 3. This is my reporting date, 31st March 25. I have to calculate how many months from here? 18 months. Means 12 months of this year, 6 months of this year. So when does my end date ends here? 30 September 26. 30 September 26 is my benchmark date. Correct? Correct. Step 1 is calculating that 12 months or 18 months, which is higher. Calculate now 18 months from the reporting date so that I can get my benchmark date. So what is my benchmark date? 30 September 26. Now the payment is happening within 15 months. Expected to happen within 15 months of what? Reporting date. Transaction date is not given. So I have to take the reporting date. So now from the reporting date, my dear friends, if I calculate 15 months, means 12 months of next year, 3 months of next to next year. So when does my due date happens to be? 30th of June 26 is my date of payment. Fourth step, check whether the payment date is on or before the benchmark date or after the benchmark date. Sir, before the benchmark date. Hence, this becomes my current liability. Majja only. Current liability. Expected payment period is on or before the benchmark date.
Can we change it with months?
Sorry?
Before it was 10 months, now it will be.
This is all independent question. All these questions are independent questions. This is not same question. Different transaction I'm given. Different cases. Now, for online people who don't understand what I answered, a student asked me, for one particular business, for one particular product, can we have different operating cycle? No. These are all the different cases. For each case, how you calculate is what I'm trying to teach. Last case, let's see how much you understood here. Your company's normal operating cycle period is 18 months. Standard is how much? 12 months. In this, which is higher? 18 months is higher. So your benchmark date is going to happen after 18 months. But the payment is going to happen 24 months of the benchmark date. So here, the payment is happening after the benchmark date. And then this is going to be my non-current liability. I'm coming. Here, 31st March 25. 31st March 25. Now, your benchmark month is how much? 18 months. Means 12 months of next year, 6 months of next to next year. Which means somewhere here, 30th of September 2026 is my benchmark date. But the payment is happened from 24 months of the benchmark date. So 24 months means what? 12 months of this year, 12 months of next to next year. So here the payment date is 31st March 27. The payment is going to happen after the benchmark date. So this becomes a non-current liability. This becomes a non-current liability, not the current liability, non-current liability. Expected payment period is beyond the benchmark date. This is non-current liability. So this question, did you create on your own? The answer is no. This question I copy pasted from T.S. Grewal. Yes. 12th standard book, which we followed financial statement. Same where I've copied. Here you made current liability, so no, sir. So in textbook, current liability was there? No. Non-current only. My staff who had done this copy paste work, he has put or she has put non-current. We are concept pakka, man. So we know who is done right and who is done wrong. That is the beauty of CA. Accountant will do all kind of mischiefs in the accounting. What is your job? Correct it. That is the beauty of CA. What is there in textbook doesn't matter. What is there here and what is there here matters. Now tell me people, comfortable, not comfortable? Online people, comfortable, not comfortable?
Comfortable, sir. Comfortable, sir.
Now what has happened is, we've understood the meaning of current liability, which is only 50%. 50% is yet to be understood. Sir, what are you saying, sir? Yes, if you don't believe me, I now present to all of you the next point, which is point number B and point number D. Now for this, you need to have some energy, some relaxation, because the next 2 points, what you're going to hear to me or listen to me, for that you need Hajmola to digest or Digest to digest. So please take a break. Don't have a Kit Kat, have a digest and come back. Thank you. Yes, people. Welcome back to the break. So let's continue. So guys, we were trying to understand the meaning of current liability. We understood point number A, point number C. Now we have to understand point number B. It says that recording started, no? Yes. A liability shall be classified as current liability if any of the following condition is satisfied. So what is my the B condition? If a liability is primarily held, or if a liability is held primarily for purpose of being traded. Sir, if I have an asset in the business, if I have a stock in the business, stock held for trading, understandable. Stock is what? Asset, no? I have stock in trade, inventory, closing stock is my asset. Asset for the trading purpose, I understand. I buy the goods with the intention to sell. Asset for trading purpose, understandable. Liability for trading purpose? Oh my God. Meaning. Listen to me very carefully. Now, point number point number B is primarily from the point of view of the CA final. But since this is the topic given in CA intermediate, it is my responsibility to explain. At so many places, they might skip this point and go, but I don't feel like skipping, so I will touch this point. I want to make profits in the business. So there are 2 ways. One, I can buy the product physically, take the physical delivery of it, add the profit margin to it, and then I can sell it. Correct? I want to make profit out of my business. So I will deal with the products where I take the physical delivery of the product. I will add my profit margin and then I will sell. But not everybody is interested into physical form of dealing with the business. So for such people, there's a concept of derivatives that is being given. Derivatives, DERIVATIVES. You have a in-depth or in detail topic in the CA final called as derivatives. You have a new chapter on this. Derivatives means what? This is the word that is derived. It's been brought down from the word derived. Derived is the word, from that the word the derivatives is being identified. Derivative means what? We're trying to derive the value from the underlying asset. Deriving the value from the underlying asset. There are different types of derivatives. Futures, options, swaps, all these are different types of derivatives. We'll be understanding in depth only in the CA final. I'm just trying to explain here only in a simple language, just to justify that point number B. Deriving the value means what? Profit or loss from the underlying asset. Now this asset could be anything. This could be commodity, this could be currency, or this could be any other value. Have you heard that the currency value keeps on changing? When I say US dollar rate is 90 rupees, means what? If I want to buy $1, I have to pay how much? 90 rupees in INR. Correct? If I want to buy Australian dollars, let's say it is 80 rupees, means what? If I want to buy $1 Australian, I have to pay how much? 80 rupees. Let's say we go to Australia. So there, what currency we have to use for buying and selling? In locally, Australian dollars. So I have to have Australian dollars in my pocket, but we don't have it in India. So what do we do? Before you travel to Australia, you'll go to the exchange centers where you will give the INR, and against that he will give your Australian dollars. So if I want to buy $1 Australian or $1 USD, how much INR I have to pay? 80, 90 or 100, whatever rate they are telling. So if I give 90 rupees in INR, and if I get $1, then I'm getting the physical delivery of the USD. Correct? So this physical dollar I can keep with me until this 90 rupees becomes 100 or 120. So the day it becomes 100, what will I do? I'll sell this dollar to some other person. Means I got $1 by paying 90 and I sold it by receiving 100. $1 I purchased. What is my buy rate? What is my buy rate? Sir, I purchased at 90 rupees. Correct? Physically, do I have the stock in my hand? Yes. Do I have the currency in my hand physically? Yes. Now, what am I doing? I've invested. Why? Because I am expecting this dollar rate to increase. Means what? I'm expecting USD will strengthen, US dollar rate will increase, and the INR will weak. Means what? To buy the same US dollar, I have to spend now how much? 100 rupees in future. So if the INR rate increases, it means that my Indian currency is weakened and US dollars has become strengthened. My rupee is depreciated and USD is appreciated. Means what? 1 month ago, to buy $1, I have to pay how much? Only 90 rupees. But today, to buy that $1, how much I have to pay? 100 rupees. Means the value of the dollar has appreciated and the value of INR has depreciated. The person who is giving the US dollar is saying, chilla fellow, 90 rupees, you keep it. If you want my USD, give me 100 rupees. Means what? In his viewpoint, our 90 rupees is chiller. He's telling, give me more money. Means INR is weakened, whereas US dollar is strengthened. On the other hand, if the rate in the future drops to rupees 80, now INR is now strengthened because I have to pay now only 80 rupees to get that $1 currency. So INR is strengthened, appreciated, and US dollar is depreciated. Are you able to follow? Now, I'm buying the USD. US dollars is nothing but currency, is like a product. How a product is bought at 90 and sold at 100. Same way this is also. Correct? No? I can sell anything. No? I can buy anything. So here I'm dealing with currency. So I'm buying physical currency and selling physical currency. Okay, this is one option. But I don't want to buy the physical currency. Boss, without buying the physical currency, I want to still make a profit on this transaction. That concept is called as derivatives. What is derivatives? Deriving the value, deriving the profit and loss from the underlying asset. In my business, what is underlying asset? Currency is my underlying asset. Am I taking the physical delivery? No. It is gambling. How the gamble works? Understand. I am telling that I am buying this US dollars at 90 rupees. I am promising you after 3 months, I will buy this US dollars at 90 rupees. Means $1 I'm going to buy at 90 rupees. Why am I buying at 90 rupees? Because I am expecting that this will become in future 100, 110, 120 it will become. Correct? Now, after 3 months, there are three possibilities. It can either become 120, it can still same be 90, or it could be 80. Correct? No? So this is present month. This is future month after 3 months. Okay. Now imagine yourself. Today I am purchasing the dollar for 90 rupees. I'm only promising. I'm not buying physically. I'm telling that in future I'll buy this for 90 rupees and the rate that is blocked is 90. So buying for 90 and selling for 90. You're buying for 90 and you will sell it also on the same day for 90. When you buy for 90 rupees after 3 months, same day you will sell it virtually. How this works, you'll understand better in final. I'm just trying to keep it very simplified. So you're buying this at 90 in the future and selling on the same day for 90. So what is the profit loss? 0. Now, today you're buying at 90. Today you're buying at 90. You are thinking that this value of the dollars in future is going to be more than 90. But unfortunately, the dollar rate became how much? 80. The dollar rate that has become 80 rupees. Means after 3 months, actually had you purchased after 3 months without this contract, without this derivatives, I would have purchased this at 80 rupees. But since I entered into derivative contract, what is the contract value here? 90 rupees. So in future after 3 months, even though the value is 80, I have to buy at what? I have to buy at 90. I'll buy at 90 and sell it how much? 80. So I made a loss of 10 rupees. Correct? No? So here in this case, derivatives, you don't do actual buying and selling. When I say actual buying and selling means what? I buy for 90 and sell for 80. Here what is happening is you will calculate the difference. Here what is the difference? 10 rupee. This is a loss. So this is like a gamble, speculation. Let's suppose I am that person, or let's say we are all that person. We are all together have decided to do gambling. Gambling in where? Derivatives. Which currency? Oh, sorry, which underlying currency? Okay. So we are expecting that in future, this 90 rupee worth of currency will become more than 90. If it becomes more than 90, our speculation, our gambling is correct. Correct? Now, we have contracted today for how much rupees? 90 rupees. Telling what? After 3 months, I will pay 90 rupees for this. I will buy at 90 rupees. Okay. So what is my buy rate after 3 months? 90 rupees. That day, what is the actual currency value in the market? 80 rupees. So your gambling proved to be right or wrong? Your speculation proved to be right or wrong? Wrong. You thought it will go beyond 90 rupees, but it became less than 90 rupees. So now, whatever you have contracted at, this becomes your contract price and this becomes your buy rate. And obviously on the same day, you have to net off, sell. So this is my selling rate. So you purchased at 90 and sold at 80. So you are actually not buying for 90. When I say buying for 90, I'm not paying 90 rupees from my pocket. They will do the net difference. So what is the net difference? Profit or loss? Loss. Means this money I have to pay to some third party. So we would have done a gambling with some person, no? To that person I have to pay now 10 rupees. Yes. So now what happens? Your buying and selling will be netted off on the same date. This is called as contract date. On the contract date, it will be netted off. On that, you will know what is the profit and loss. Loss means that much money you have to pay to the opposite party. Basically, this is like gambling. Two matcha are coming together. Matcha today 90 rupee value. After 3 months, I am telling more than 90. You are telling less than 90. Any one person will win. So we expected more than 90. Our fall of what you call opposite matcha said that no, it will be less than 90. So he's betting for less than 90. We are betting for more than 90. More than 90 comes, we will win. So we will take money from him. If less than 90 comes, he wins. We have to pay him the money. Betting all of you know. Macha, idu vanda, nee win. Adu vanda, na win. Like that same betting gambling only. So now, who won in this case? Opposite matcha won. Correct? So we have to pay him 10 rupee or 10 lakh rupee. Nobody deals with 10 rupee, man. Multiples of lakhs. 10 lakh rupees you have to pay. And this you have to pay within 12 months period, because this contract period will never go beyond 12 months. It's a short-term speculation income, short-term gambling income. So I have to pay this money in future. Now this 10 lakh rupees, I will classify it as what? Current or non-current? Current, because on the contract date or within few days of contract date, I'm supposed to settle this 10 lakh rupees to opposite party. So from the benchmark date, from the reporting date, I have to settle this within 12 months period. It comes within 12 months period, and this becomes my current liability. So one more time, listen to me very carefully. If any current liability is held primarily for the purpose of being traded. So here the currency what I had, the derivative contract, not currency. Here what is my liability? The derivative contract is my liability. Now the 10 lakh is triggered. I have to pay the 10 lakh rupees loss. So that is my current liability. Liability held primarily for the purpose of being traded. So meaning of this I have given here below. What is the meaning of current liability held primarily for the purpose of being traded? Meaning, it refers to financial obligation. It refers to financial obligation that arises from the short-term trading activities. Can I say that trading what I done? Speculation, the derivative contract I've done is for short-term period. How many months? 3 months in our example. Usually in derivatives. So this short-term trading activities usually happen in a concept called as derivatives or financial instruments. What is the meaning of derivatives? Financial instrument. You'll understand in depth when you do CA final. And that derivative contract and the financial instrument contract, the settlement of that is to be done within 12 months. These liabilities typically result from the speculative trading or financial contracts that are not meant for long-term holding. So now the 90 rupees dollar I'll buy, I contracted, no, I don't have the intention to make the physical delivery, first point. Second, I have the intention to benefit out of it within a short period, within 12 months. In our example, the contract period was 3 months. So within 3 months, I got to know the result and immediately I have to make the settlement, and this becomes my current liability. It means that the certain liabilities are created not for regular business operation, but for trading or speculative activities. In business, there are certain liabilities happening, not in the regular business operation. If I buy the dollars and sell the dollars physically, if that is my routine business, then that is my regular business operation. In that case, you will classify this as current and non-current liability as per point number A and point number C. This is something which is very different from the regular activity, which is speculative in nature, which has got a derivative contract or financial instrument coming into picture. Then for you, point number A and point number C is not applicable. Then for the point number B is applicable. These liabilities arise when the company engages in buying and selling financial instrument and that is or derivatives, financial instrument or derivative, and is expected to be settled, net settlement. So 90 is the buying rate, 80 is the selling rate. Net settlement is how much? 10 rupees, which is expected to be settled within 12 months of the reporting date. So such derivatives are multiple types. Future option swaps are multiple types of derivatives with the intention to make the short-term profit. So if you are entering into any financial instrument or derivatives contract in form of either futures or options or swaps, where you have the intention to earn money out of speculation, gambling, and that money is supposed to be settled within the shorter period of time, then this liability will be classified as current liability. These liabilities typically result from speculative trading or financial contract that are contracted for a shorter period, less than 12 months, and not for long-term holding. I think same points has been repeated. It's okay. I'll delete it. Example. A company trades. Trades means physical trade or gambling trade. Gambling trade on the paper, not physically. What am I dealing with? US dollars. And this is called as futures. So future is coming under which concept? Derivatives. Derivatives got multiple concepts. Futures, options, swaps are all multiple types of derivatives. So if the company is trading in the derivatives, which type of derivative? Futures. What am I doing? I'm buying USD. I'm dealing with USD and INR. It means the company contracts to buy 1000 US dollar at 100 per US dollars. Means I'm buying 1000 quantity of USD at 100 rupees per USD. At 100 rupees per USD. Now treat USD like a product. Let's say this is the product. I'm buying 1000 pen and each pen is costing 100 rupees. Am I going to do the physical delivery? No. Am I going to do the physical delivery? No. It bets. We are betting that the dollar will appreciate. Dollar will appreciate. Means what? The value of the dollar will be increasing and rupee will decrease. But what happened? But instead, it depreciates, weakens, and it is trading currently at 90 per US dollar. Now you have contracted to buy this pen in future for how many rupees? 100 rupees. Today I've entered contract. Today is what? 28th February 2025. The contract is for how many months? 3 months. The contract is for 3 months. After the third month or on the third month, whatever the value is, that value I will sell it. So what is the contract buy date today? Today's date, buy date, and buy rate is how much? 100. So today, that is 28th of February, I've contracted to buy in future at what rate? 100 rupees. Which means after 3 months, 3 months after that, how much? March, April, May. 28th May. Whatever the rate is, that will be your selling rate. But you will buy at what rate? The contracted rate. So what is the contracted buy rate of 28th May? Buy rate 100. On that day, what is the rate? 90 rupees, and that day becomes my selling rate. You were expecting the dollar rate to appreciate, but instead it depreciated. So now, solution for this. The company entered into derivative contract. Why it is derivative? Because I'm not taking the physical delivery. We are into speculative calculations, speculative way of earning income, which is futures. You understand futures when you do CA final. The company entered into derivative contract, which is future contract, for speculative purpose, betting on the currency movement. That's what we did. No, we are speculating that the dollar price will increase, decrease, and we are playing with that. So we're playing with the fluctuation of the foreign currency. Correct? No? Now what happened? Since the company expected the US dollar to appreciate, they thought the rate will increase from 100 to 120 or 130, but instead what happened? It depreciated, and now the company's incurred a loss of how much? 10,000. How? Because the buy rate is how much? 1,000 US dollar into 100 rupees. So I'm buying it how much rupees? 1 lakh. On the contract date, what is the actual value of the dollars? 90 rupees. And that day you will sell it at that rate. So what is my selling rate? 100 into 90. So what is my selling rate? 90,000. So on that day, you're buying it for 1 lakh rupees and selling it for 90,000 rupees. So you are having a loss of 10,000 rupees. This loss of 10,000, it has to be settled within the set period, and hence it would be called as current liability, held primarily for the purpose of being traded. So this loss is the amount that I have to pay to someone in future. I have to settle this amount. So until I settle this amount, this is my current liability. So let's say on 31st March, you calculated this. You're supposed to settle, you have not settled it. So until you settle this becomes your current liability. Can I classify this as current liability as per point number A and C? No, because that is happening in the normal course of business. This is what not happening in the normal course of business. This is speculative transaction. The normal business is not speculation. That is proper business. This is gambling business. Gambling means don't think what casino we do. No. This is proper, officially allowed way of earning the money from the business. This is officially allowed. Futures, contracts, derivatives, options are all normally allowed. Is legal in India. Yes.
Is that the contract date thing necessary, sir?
What?
If on that date we didn't sell the currency,
It will trigger. When I say that's what I'm doing, this is a CA final topic. Actually, how this works, you'll understand in a better way in the CA final level. Here, first of all, you will not get question based on this. Second, since it is there, it is my responsibility to explain. So I'm trying to explain in a simplified manner, because if I start explaining, this will take at least 2 classes. So I'm not going too much into depth. My humble request is don't go too much in depth. I'm trying to keep it very simple, that you are entering into some speculative contract today, telling that 3 months later I'll buy at that rate. So your buy rate has been fixed. On that day, whatever is the actual rate, that is your selling rate. So if your buying rate is more than the selling rate, you are at loss. If your buying rate is less than the selling rate, buy rate is less, selling rate is more, it is your gain. So in that case, if let's suppose we take this example, your buying rate is 90, and on the date of contract execution, the selling rate is 120. So how much profit you have made? 30 rupees profit. Now you have to receive from the opposite person, because you have betted the rate will increase. So as you thought, the rate got increased from 90 to 120. So what is the difference of profit now? 30 rupees you have to receive. So it becomes my current asset. About current asset, I'll discuss in the upcoming class. Now for the opposite person, it becomes current liability. For you, it is current asset you have to receive. But the opposite gentleman who lost the bet to you, he has to pay, no? So for him, it is current liability as per point number B. Is the logic clear? Only people, is the logic clear?
Yes, sir.
Yes.
Yes, sir.
I've taken a lot of efforts to research all these points and put it on the plate. Rest, I bet you go anywhere in YouTube, search. I searched, I know. What best example I can take? I didn't get one single. I'm telling you, trust me. One single place also I didn't get this information. Here and there, chumma upar upar se they've explained went. But proper understanding with example, you hunt and show me the videos. I bet. Why I'm telling this point is because that is the effort that your sir is putting into it. If I can put so much of efforts for you, for your understanding, then how much efforts you have to put for your own understanding plus clearing the exams. Think about it. Last point. Compared to point number B, this is still okay, but important to understand. Chances of this coming in exam is very less, but possibility is there. A liability shall be classified as current liability if it satisfies the following condition. What is that? The company does not have an unconditional right to defer the settlement of the liability for at least 12 months after the reporting date. This point you can leave it. This is a CA final topic. I'm not covering it here. But first point definitely we can cover. The company does not have unconditional right to defer the settlement of the liability at least 12 months after the reporting date. So you take example for this. First, let's understand the meaning. Then we'll see example. Then we come back and study again the meaning one more time. The company does not have the unconditional right to defer the settlement of the liability for at least 12 months after the reporting date. What is the meaning of this line? This means if the company cannot legally or contractually postpone the payment for at least 1 year after the financial year end, it must be treated as current liability. So meaning itself is dangerous, sir. This point is dangerous, we can understand. Meaning also is dangerous. Amma, welcome to CA Enter. Now we'll understand this in a better way through the example. Alvin, correct? இதுக்கே காஞ்சி போச்சுன்னா எப்படி இன்னும் நிறைய இருக்கே example. That is the role of a teacher. What is the role of a teacher? To simplify the conceptual, what is it? Critical complex language which is given in the textbooks. Example. A company has a bank loan of rupees 10 lakh. Company has a bank loan of 10 lakh. Means I have taken a loan from bank. A company has taken a loan from bank for 10 lakh. And the bank can demand the repayment. Bank can demand the repayment anytime. The bank wants the payment anytime within the 6 months of the reporting date. From the reporting date, they said that I can ask the money anytime. But the company does not have the right to delay the payment for at least 12 months after the reporting date. Listen to me very carefully. You have taken a loan here, 1/4/2024, telling that you will make the repayment after 15 months. You've taken the loan on 1 April 24 from the bank. I'm giving a different example first. Then I'll come back to this example. Purvi, I'm telling that you've taken a loan on 1 April 24 for 15 lakh rupees, promising that you will make the payment after 15 months. Means what? 15th month end is your due date. Correct? Please tell me, when does the 15 month ends? When does the 15 month end? 31st June कब से हो गया बे? कौन बोला? 30 June मा? I'll send you to one standard again. 30 June 25. This is the due date for payment. Correct? Can I say I have the exact due date? I have the exact date of payment. In this case, will you apply point number A, B, C, or D? Point number not current. Sorry. Point number C you will apply because I have a due date in my transaction. If any liability is if any liability is due to be settled within 12 months of reporting date, then as per point number C, this becomes my current liability. How do we calculate this? Very simple. Step one is what? 12 months operating cycle period or the normal operating cycle period, whichever is higher. Here, can I say normal operating cycle period is not given? So this also becomes 12. In the absence of the normal operating cycle period, you have to assume it is 12 months. So standard is 12 months and this is also 12 months. Which is higher? 12 months. Step 1. Step 2 is to calculate this 12 months from the reporting date. So what is my reporting date? We are preparing the balance sheet on 33 March 25. So from here, if I have to calculate 12 months, when does my benchmark date happens to be? Benchmark date is happening on 31st March 26. Third, you have to fix the date of payment. This is my date of payment. Can I say it is fixed or it is not fixed? It is fixed. If it is not fixed, you'll come to point number D. If it is not fixed, I can ask the payment anytime here. Like the bank says, means it is not fixed. But here, what is the language saying? Banker says that if you are taking loan on 1/4/24, you have to make the payment after 15 months. Due date is 30 June 25. So due date is known to you. So as per point number C, you have to classify this as current or non-current liability. So now the date of payment is before the benchmark date. This is current liability as per point number C. Can you defer the payment? If the company says you can defer the payment, if the bank says you can defer the payment, defer means what? Postpone the payment. Then that's a different story. But here have they said postponement not possible. So postponement not possible, plus the due date is fixed. So I'm classifying this as current liability as per point number C. What is point number D trying to say? The company does not have unconditional right. Forget this word unconditional. The company does not have the right to defer the settlement for at least 12 months after the reporting date. Now let's take the same example what I've read here. Here the company has taken a bank loan of 10 lakh rupees. Now the bank can demand the repayment any time in that 6 months of the reporting date. 6 months of the reporting date. So what is my reporting date? When did I take the loan? Somewhere before they have taken the loan. I'm not bothered about it. They have taken loan somewhere ago, some years ago, some months ago. I'm not bothered. What I'm trying to calculate is that the date of payment is supposed to be 6 months, anywhere from 6 months of the balance sheet. Means from this reporting date, 6 months will get over when? When? 30, April, May, June, July, August, September, 39, 25. Anywhere in the 6 months, they can ask for the payment. Who can ask? Bank. And next condition is that this payment you can defer, but you cannot defer beyond 12 months of the balance sheet date. Means if they ask you payment here, you're not giving the money. You will drag the payment, but you will settle by 31st March 26. If that is your intention, sir, they will ask anywhere the money here in this period, but we will defer it, but not beyond 12 months. Not beyond 12 months. Look at the language. The company does not have the right to defer, does not defer for 12 months of the reporting date. They will defer, but they will not defer beyond this 12 months period. Look at the language. Look at the language. The company does not have the right to defer. The company does not defer for 12 months after the reporting date. Means they will defer till 12 months of the reporting date, but not beyond 12 months. If they're deferring beyond 12 months, then this liability becomes non-current liability. Reporting date is the date when you prepare the balance sheet. So if I'm in this financial year, which is 24-25, 31st March 25 is my reporting date. Reporting date is the date on which you prepare your balance sheet.
So you're saying the company cannot defer it more than 12 months, but
Correct.
if it differs
Within that year, it is allowed. Now you will ask a question that, so what is the difference between point number C and point number D? In point number C, this is the due date. What is the due date? 30 June was the due date. You cannot defer at all. That is point number C. Point number D, you can defer, but you cannot defer beyond the 12 months of the benchmark date. Purida, are you able to follow? Online people, are you able to follow?
Yes, sir. Yes.
In
Yes,
point
sir.
number C, when they say that a liability will be classified as current liability if it is due to be settled within 12 months of the balance sheet date. So 30 June is my due date and is due to be settled within the balance sheet date, within 12 months of the balance sheet date. So I cannot defer the payment at all. So if you defer the payment, default the payment, that's a different question. On 30 June, I can do anything. But on 31st March, I don't have the intention to defer. So point number C does not allow you to defer. Point number D allows you to defer, but not beyond the 12 months of the balance sheet date. Deferring is possible, but not beyond the 12 months. Now, this way of constructing the language is called as negative construction of the language. Have you heard this in English language? In English, you have positive way of constructing the line, sentence. Positive construction of sentence and negative construction. This is negative construction. What is that called as? Active and passive? No, that is different, man. Law is like this only. They will never eat like this. They'll eat like this. Correct? Easily they could have framed the language. Easily this language had given to a 12th standard student, would have framed and given the language properly. I don't know who framed this language. They've touched the nose like this. The company does not have unconditional. What is conditional? I can defer to subject to condition. Here is no condition. You cannot put any condition. No condition. Unconditional. Right to defer the liability for at least 12 months of the reporting date. This means if the company cannot legally, contractually postpone the payment for at least 1 year after the financial year. You cannot postpone beyond 1 year. But within 1 year, you can play. Within 1 year, you can play. It must be treated as current liability. It means if the company cannot legally and contractually they say, see, I can ask money in 6 months. You can defer it, but not beyond so much of date. So in that case, it becomes my current liability. Let's take one more example. A company has a loan of 8 lakh, which is due within 6 months of the reporting date, balance sheet date. But they are in talks with the bank for extension. Now they're going to bank and asking for extension. When on 31st March, all this drama is happening. Please understand. All this data is given to you when? As on 31st March. However, the bank has not agreed for extension. Are you able to follow? Since the company does not have guaranteed right to delay the payment, this becomes my current liability. Listen to me very carefully. On 31st March, we are preparing the balance sheet. 31st March 25. Now, this money is due for payment or expected to be paid anywhere in 6 months. Is it due date? This is not the due date. This is expected. Somewhere here I can make the payment. Whenever the bank asks, I have to make the payment. Can I defer it? Yes. The deferment is possible for another 6 months, but not beyond 31st March 26. On 31st March 25, the company is actually talking with the bank. Bank. I don't think so. By 31st March 26 also I can make the payment because I'm running short of money. So please extend request. Bank has not accepted the request, which means what? I cannot defer the payment beyond 12 months. I have to make the payment within this 12 months. Now please tell me, in this scenario, will you classify that bank loan as current liability or non-current liability? Here, focus here. Is it current or non-current liability? It is current liability. It is current liability. Imagine on 31st March 25, the bank had agreed for deferment. Chalo, no problem. I accept your request. Which means I can defer the payment beyond this 31st March 26. In that case, this liability is now becoming non-current liability. Only if the company has legal or contractual right, which means contractually, in the contract, when you went and requested the bank has made a revised contract. In that contract, they said, okay, you can delay beyond 31st March 26. Like that, if you're signing and giving, in that case, that liability becomes my non-current liability. Am I loud and clear? What is the meaning of due to be settled within 12 months of the reporting date? This statement is about actual due date of the liability. Point number C says what? Due date to be settled within the reporting date. Within 12 months of reporting date, I'll have one due date. On the due date, I have to settle. I cannot defer at all. That is point number C. In point number D, you have to settle within the 12 months of reporting date, but there is no actual due date. Anywhere in between, you can settle. You have right to postpone, but the postponement deferment should not happen beyond the 12 months of the reporting date. The liability must be, if a liability must be settled within 12 months, it is automatically a current liability, whether the company delays or not. It's okay. This main point is about understanding what is point number C. It is due to be settled. Means what? The due date falls within, exact due date falls within the 12 months of balance sheet. Means you have no right to deferment. That is point number C. Example, a company has a bank loan of 10 lakh. The bank demands repayment on a specific date, which is falling within 12 months of reporting date. This is the financial reporting date. From here, if I calculate 12 months, this is my benchmark date. The question says that the bank has demanded repayment on specific date, and this date is falling within 12 months of reporting date, somewhere here. And this date is fixed. So now tell me, this is a current liability as per point number C or D? C. As per point number C. So this loan will be classified as current liability in the balance sheet as per point number C. Correct? No, you'll have a doubt. No, upon C and D and I've given the comparison my own self. Today you'll not ask this question because you're having difficulty in digesting this concept. I said no before break. This is a concept which is difficult to digest. You have to take Hajmola, Digene. Correct? No? Correct? No? So now your brain will not be asking this kind of question. So whatever question you're going to ask me in future, that itself I've asked my own self. So this is as per C or D. You have to be very, very crystal clear in this. Am I loud and clear?
Yes, sir.
Online people, am I loud and clear?
Yes, sir. Yes, sir.
This class, you only discuss current liability? Yes. If this is not clear, no, you will not be able to classify item properly as current or non-current. Now, if any of these 4 conditions satisfied is current liability. If none of these 4 conditions are being touched, then everything is my non-current liability. So what is non-current liability? Anything which is not current liability is non-current liability. Correct? No? Now, so are we done? No. Sad. Now, Under non-current liability, sir, what do we have? Non-current liability is more long-term liability. I'm going to pay beyond the benchmark date. Means I have a lot of time to arrange the money. I can arrange this money aram se, relaxed. So under this, how many categories we have? Subcategories. Sir, 4 subcategories. One is called as long-term borrowing. Second is called as deferred tax liability net. This I will be discussing with you in accounting standard 22. In 12th standard, what did I say? DTL not applicable. We'll discuss in CA one day. That day is come. Not now, after a few months. Third one is what? Other long-term liabilities. Other long-term liabilities. And the last one is long-term provision. The accounting of this will be discussed in depth in AS 29. We are not doing accounting. We are just trying to do the classification. So without AS 29 also we can do the solution. So my question goes to all of you. Under equity and liability, how many categories do you have? Name please. Shareholders,
Shareholders
funds,
fund,
share application money,
Share
pending
application
allotment.
pending allotment.
Non-current liability.
non-current liability,
current
current
liabilities.
liability.
Under shareholders funds, how many sub-classification do you have? 3. One is share capital,
Share capital.
reserves and surplus,
Reserves and
money
surplus,
received against.
money received against shareholders.
Shareholders.
Under non-current liability, what do you have? 4. Long-term borrowing means what? I'm borrowing the money from somebody. Whom will discuss? Deferred tax liability net.
Deferred tax liability.
Will I discuss detail now? No. It will be discussed when I deal with AS 22. Other long-term liabilities and long-term provision. Under long-term borrowing, what do we have? Very simple. It's easy. You only have this many classification: A, B, C, D, E, F, G. Sir, are we supposed to remember all this in proper order? Yes, if you're preparing the financial statement in reality. If you're going to send somebody's balance sheet, then this format ditto you have to copy paste. You cannot change. But for examination purpose, you are free to record this in any order. So do I need to remember the order of the notes to accounts? No. Do I need to remember the order of the financial statement, balance sheet and P&L? Answer is yes. What? No. Albin. P&L format order, you cannot change. Remember. Balance sheet format order, you have to remember. Under that, notes to accounts is there, no? Luckily in CA intermediate, the order is not required. You can change the order. For example, loan to debtor you can record first and bank you can record second, no problem. But in reality, when you go to auditor office, when you practice, that time can you change the order? No. Now, what is the first item? Bonds and debenture. All of you know what is debenture? You studied this in 2 places. One in 12th standard, second in CA foundation. Who studied in 12th standard? Student who are coming from CBSE background, you studied this in 12th standard. Student who came from matriculation state board background, you studied this in CA foundation. If a person who is coming from matriculation background, who has skipped foundation, did you study debenture? No. Correct, no? Matricular particular. CA foundation skip பண்ணி data entry உள்ள வந்திருக்கான். So what debenture you don't know. So in that case, can I sit and explain what debenture is? I can explain meaning. Summary I can give. Can I go in depth? Debenture, we spent one whole chapter on debenture. We have done multiple questions. Is it possible for me to do it here? If I do everything here one more time, then what is the difference between foundation and intermediate? This is advanced accounting, not accounting. Debenture is one way of borrowing. So you borrow the money from public. In return, what do you give? As acknowledgement, the debenture certificate. So what is the money that you give in return for enjoying that money? If I get 10 lakh rupees from public, if I give debenture, what am I giving them in return? Interest I am paying them. So if I am taking 10 lakh rupees from public, what am I paying in return? Interest. So debenture is a borrowing. Do you understand what is borrowing? If any company wants, see, all of you know, in a company to run business, we need funds, finance, paisa. I can get funds from 2 sources. One from owner. If I get money from owner, it is called as capital, equity. Or I can get money from bank, public, third party. That is called as borrowing. So one is borrowing, one is capital. So here we're talking about the borrowing. Borrowing means what? We're getting the money from third party. We're getting money from third party. He may be known to me, he may not be known to me. So borrowing are in multiple forms. I can take loan from bank. I can take loan from public, general public. I can take loan from, let's say, relatives, friends. One is loan. Sometimes this loan is being wrapped up with a wrapper name called as bond, debenture, and there's a new feature attached. You get my point? If a product is wrapped up with a new wrapper name, and if I give new feature to it, it becomes a new product altogether. So like that, bond, debenture, loan are all borrowing. So you have to classify in business bonds and debentures separately. In business, you have to classify the loan separately. What is term loan? What is the meaning of term loan? If I go to the bank and ask, bank, give me loan, he will verify all my documents, and one fine day he'll put 10 lakh in my bank account. Whether I use that money or not, I have to pay interest. That is term loan. I'll be to follow. Term loan you'll get from bank, or you'll get from other party, friends, families, relatives, etc. Now here what is important? No, to classify whether this loan is secured or unsecured. This is the important disclosure that you have to give. Whether this is secured or unsecured. What is the meaning of secured or unsecured? Yes. Now what happens is that when you go to the bank, in the bank, please give me 10 lakh rupees. I want to put one more branch in Chennai, and for that I need 10 lakh rupees. 10 lakh is sufficient, not sufficient. 50 lakh rupees. Academy rent is easy. 50 lakh rupees you need to buy. Not 50 lakh in the land. 50 lakh will, in that 10 lakh to 15 lakh will go in advance. Rental premises, 50 lakh you cannot buy place. For Chennai, if I buy one nice 3,000, 4,000 square feet academy, then you have to shell out for 10 to 15 lakh rupees only for advance. Furniture, multiple AC, interior work, false ceiling, projector screen. Oh, you 50 lakh rupees they want. And first year, all the students will not come like that. No, the trust has to be created. But rent I have to pay every month. So I need working capital also. So all put together 50 lakh rupees. When I go and ask this to bank 50 lakh rupees, what will bank see? First he'll see from top to bottom and laugh at me. Security means what? He's telling that if you don't pay this 50 lakh rupees on time, do you have any asset from which I can recover the money? Well, he will see that. That is what is looked from top to bottom. That is why whenever you go to bank, no, you should wear tie, nice shoes, belt and go. Here and there, old shirt if you wear and go, loan will not come. Then and there, reject. Correct, no? So now, when the banker is giving the loan to you, he does not know your business. He does not know you personally. Even if he knows also, on what basis he'll give you the loan. Tomorrow, if you take the money and go out somewhere, correct, no, whom I'm talking about, you know, no? If you abscond, from where will I go and recover money? As a bank manager, the bank manager will be in trouble. The bank manager is going to be in trouble. His job is in trouble. So he will ask security. Means what? He will tell, do you have any property? Purvi, do you have any properties? What the banker asks. He'll say, I have, sir. He will want the property value to be more than the loan amount. So if I'm asking 50 lakh loan, no, at least he will want my property value to be 75 lakh and above. Purida. Yeah, and the extra 25 lakh he wants cushion. Tomorrow, if I default interest also, that interest also I should be recovering from that asset. So tomorrow, if I'm getting the loan by giving my property papers, I'm not selling the property. I'm just giving my property documents to him as a mortgage pledge. Adamanathukku vechirukken. That is called as mortgaging, pledging. Means this loan is secured against the land what I had. So if you have secured the loan against any asset, you have to mention that this is secured against land. This is secured against building. This is secured against plant and machinery. Like that, you have to give the information about the security. If there is no security, like that, if any donkey is stuck, who's giving the loan to you without security, then you have to mention this fellow is a donkey. Means what? Unsecured loan. Donkey you cannot put, no. So you have to put by the word unsecured. Means what? Martinda. Unsecured. So you have to mention security and unsecurity. So now as a chartered accountant, your responsibility is to disclose whether this loan is secured or unsecured. Am I loud and clear? Deferred payment liabilities keep on hold. Deposits, the deposits you take it from the public. From public, you can take money in different forms. You can take money in form of loan. You can take money in form of bond. I take money, give bond. The bond has got different features. I can take money and issue debenture. Debenture has got different feature. I can take money in form of deposit and that is called as a different feature. Correct? No? Now, for example, think from banker point of view. Banker is taking money from you. How? You are putting fixed deposit. No. So for it is fixed deposit. But for him, it is a deposit received from the public. Think from bank point of view. You are a bank. Some customer is coming and put FD in your bank account. So for him, it is FD, asset. But for you, it is liability. That is what public deposit, unsecured. Banker was taking deposit from the public, fixed deposit. Did you Banks say, I'll give my land as a pledge for fixed deposit. Did ever bank give their property as a pledge to you? No. Correct? So those kind of deposits are classified here. Am I right? Loud and clear? So companies we're talking about. Companies also do take deposits from the public. If the contractual agreement talks about deposit, then it will be called as borrowing in form of deposit. So you have to see what is the underlying contract. If it is bond, then you'll call borrowing in form of bond or debenture or public deposit. So bond and debenture in point number A, term loan in point B, and deposits in point D. Loans and advances from related parties. Oh my God. Related parties means what? Those people who are my near and dear ones who have the control on the business. It's called as related parties. We'll be talking about related parties in deep in the upcoming sessions. This word looks very short. Related party. You dangerous definition, my there. Very dangerous. So now, loan from director, loan from relative, intercorporate loans. All this we'll discuss in the upcoming sessions. So we have loan from these people. You will classify under point number E. F is what? Long-term maturities of finance lease obligation. Keep this pending, I'll discuss. And finally, other loans and advances. Anything which does not come under A to F will come under point number G. Sir, for exam purpose, do I need to remember all of them? You need to remember the point, but no need to remember the order. To remember all these points, but no need to remember order. Second, all this name will be given in question. You just have to ask yourself whether this is current or non-current. If it is non-current, it will come under long-term borrowing. This order, anyhow, you can change. Not a big deal. Am I loud and clear? Now, in point number A to G, do you have any doubts on what is bonds and debenture? All of you know what is debenture? Bond is also like debenture only. So, point number A, can I say you have no doubts? Bond is nothing but I've taken a money from you, loan. Against that, I'm paying interest. But there'll be a slight difference between bond and debenture, which is not required now. When the right time comes, I'll discuss. So bond and debenture are more or less same. Can I say? Okay. Term loan, you have no problem. Loan taken from bank. Where the day when the banker is giving that money in my bank account, from that day, the time bomb will trigger. Means what? From that day, I have to pay interest. Whether I'm using that money or not, I have to pay interest. That is called as term loan. Okay, va? Deposit, you should not have any problem. Agree with me? Loans and advances from related parties should not have any problem. That is loan taken from director. You know who's director? Yes. Relative of the director. And the corporate loan. First 2 points, you have no doubts. Can I say? Other loans advances. If you're taking loan from any other perspective or any other person or under any other circumstances, you classify under point number G. You should have problem only with deferred payment liabilities. Am I right? This you're not able to understand. And second is long-term maturities of finance lease obligation, you're not understood. With these 2 points, I'll wind up my discussion for today. What is the meaning of deferred payment liabilities? It refers to amount owed by a company. It refers to the amount that is owed by the company, which are payable over extended period of time, typically beyond the 12 months or the operating cycle period. Beyond 12 months or the operating cycle period. Correct? No? It is non-current liability. These liabilities arise when the company has agreed to pay for the goods or services at a later date, usually in installments. So deferred payment liabilities. Deferred payment liabilities are not due for immediate settlement. We will not pay them immediately within the balance sheet date. Within 12 months of balance sheet date, we will not pay. We will pay beyond the reporting date, beyond the 12 months of the reporting date. Meaning they are spread over a period and are classified as liability on the company's balance sheet. Now we'll take an example. Suppose a company buys a machine worth 10 lakh rupees. Suppose a company buys a machine worth 10 lakh rupees, but the payment is spread over 5 years. Means what? I should pay this 10 lakh in how much portion? 5 portion, 5 installment, 5 part. The company agreed to pay 2 lakh annually over 5 years. Means first year end 2 lakh, second year end 2 lakh, third year end 2 lakh, fourth year end 2 lakh, fifth year end 2 lakh. So 2 lakh, 2 lakh, 2 lakh for 5 years if I pay. How much money paid? Full 10 lakh paid. And this liability would be recorded as deferred payment liability. Which liability is recorded as deferred payment liability? Now look at the breakdown. As on the balance sheet date, 31st March, how much money is pending to be paid? Full 10 lakh is pending to be paid. Because I'll pay, guys, please understand when I'm telling 10 lakh is pending means what? As on 31st March, full 10 lakh is pending. You will start the payment when the first day begins from the next year. So next year, you will start making the payment. Correct? Now, can I say the next payment which is happening in the next year is happening within 12 months of balance sheet date? So the first installment is going to fall within 12 months of the reporting date. So that first 2 lakh is going to be my current liability. For example, you've taken one machine here in this period. As on 31st March, the 10 lakh is due for payment. When will you start making the payment? From the next financial year onwards, you'll start making the payment. So somewhere here, you're making payment of 2 lakh, first installment. Okay. Then after that, second installment, then third installment. Now, this is the reporting date. From that, if I calculate the benchmark date, can I say 31st March 26 is the benchmark date? Within the benchmark date, can I say I'll be paying the first installment of 2 lakh rupees? Then this becomes my current liability. But the remaining 8 lakh rupees is there. No. When am I going to pay? After the benchmark date. So this is called as non-current liability. Non-current liability. Now, being a non-current liability, where will I classify this? Where should I classify this? Now, the option what you have is you have long-term borrowing, other long-term liabilities, and long-term provision. Borrowing means what? When I have to pay 10 lakh rupees for this, I'm not paying this 10 lakh to vendor. To get a loan to get this asset, I've taken loan from the bank. So I have to pay installments to whom? Able to follow. So now, this 8 lakh rupees what you have to pay will be called as deferred payment liability, which is pertaining to goods and services. This pertaining to goods and services. I'm buying one goods or service. The payment is going to happen beyond the benchmark date. Here, what example I've taken? Machine. Machine would not be an opt. Or maybe this could be a machine which I'm trading, buying with intention to sell. And now I've taken a loan for 10 lakh rupees on that. Guys, this is borrowing. Please understand, this is not a product that I have to pay to creditor. Creditor, the payment is done. I'm making the payment to whom? Bank. Then it is coming under borrowing. Are you able to follow? This we are talking about the borrowing. So I'm going to settle this payment to whom? The banker. So where will I classify this? Deferred payment liabilities. Long-term borrowing is correct, but where in the long-term borrowing? Deferred payment liabilities. The payment which is going to be deferred beyond the benchmark date. Deferred payment liability. Am I loud and clear? Online people, am I loud and clear?
Yes, sir. Yes, sir.
One more time, we'll read this. Deferred payment liabilities. It refers to the amount owed by the company to whom this is a borrowing. So it could be to anybody. So basically the 10 lakh what we're discussing, it's a borrowing which are payable over the extended period, more than 1 year, typically beyond the 12 months of the operating cycle period. These liabilities arise when the company has agreed to pay for goods and services. Because if it is asset, then it comes under the next point which I'm going to discuss. It is typically for goods and services you've taken, but you're not paying in one shot. You've taken the help of some party, and to that party you're going to pay, which is more than 1 year. These liabilities arise when the company has agreed to pay for the goods and service at a later date, usually in installments. Here, how many installments we have? 5 installments. Deferred payment liabilities are not due for immediate settlement. So out of 10 lakh rupees, how much is due for settlement within 12 months or immediate settlement? 2 lakh. I'm going to pay 2 lakh rupees within next 12 months of balance sheet date. Siddharth, next 12 months of balance sheet date. But the remaining 8 lakh is there. No, it is not due for immediate settlement. I'll pay gradually. So these are called as deferred payment liabilities. Deferred payment liabilities are those which are not due for immediate settlement, meaning they are spread over a period and are classified as liability on the company's balance sheet date. Means I'm going to pay beyond the benchmark date. So as on today's reporting date, I'll classify that as what? Long-term borrowing. Where in the long-term borrowing? Deferred payment liabilities. Is the logic clear or not clear? Now comes what is the meaning of long-term maturities of finance lease obligation. With this, I'll wind up. Sorry, please excuse me, because if I touch this topic, I have to finish it. Once we're done with this category, I can go to next category comfortably in the next class. So next point, what your doubt is, what is the meaning of long-term maturities of finance lease obligation? Long-term maturities of finance lease obligation. A company signs 10-year finance lease for equipment. What is finance lease? You're telling that I will buy the asset. I'll buy the asset. Finance lease is a different concept. We have accounting standard governing this. You'll understand that in that point of time. As of now, just understand, a company signs a 10-year finance lease. Means what? I'm going to pay 2 lakh per year for next 10 years. A company signs 10-year finance lease. Finance lease, you understand? Lease means what? I'm going to pay 2 lakh rupees per year for next 10 years. And after that, the asset becomes your own asset. A company signs a 10-year finance lease for equipment and owes the company saying, I'll pay 2 lakh per year for next 10 years. How much money you have to pay? 20 lakh rupees. Now, at the end of the first year, the next 9-year payment, that is, for example, this is the reporting date 24/25. On 31st March rupees, how should I classify this? At the end of the first year, the next 9 years of payment, which is 2 lakh into 9 years, will be classified as long-term maturity of finance lease obligation. Now listen very carefully. You have taken one asset on lease. What is the meaning of lease? You're going to pay a rental for that particular asset. At the end of the period, this asset will become your asset. You will own it after the final installment. This installment is going for how many years? 10 years. Now, the first installment is going to happen within the 12 months of the balance sheet date, because somewhere here I have to make the payment. So, out of 1 second, 2 lakh into 10 years means how much? 20 lakh payment. In that, 2 lakh ka payment will happen within short period of time. So, this is my current liability. Remaining 18 lakh rupees I have to pay because I have purchased the asset on lease. Means what? I will get the ownership of the asset only at the payment of the last installment. Until then, that asset will be under the control of the person who is lending me this finance. Means an organization has lent me this equipment on the finance lease purpose. So this finance lease, I'll give you a constructive example when I come to this particular segment. Because at this stage, for all these items, in depth, if I start explaining what happens, we will not be able to complete this chapter on time. 90% things can be explained here, and that I will explain only which is relevant to this topic. But there's some topic which I cannot explain in depth here. I'll be explaining this when the right time comes. There's a separate accounting standard governing this finance lease. The accounting treatment is separate. So that time I'll give you a proper format in terms of how this finance lease works. In that, who is the person who is supplying the machine? Who are we who's buying the machine? Who is the person who's financing this asset? So I will give you a proper chart. Now, don't complicate too much. I just have to explain in a very simple language here. So I'm not complicating. So you have taken an asset for 20 lakh rupees, which you're promising to settle in the next 10 years. The person who's lending the finance for this, he says that until you pay the installment, final installment, the control, you may use that asset, but the ownership will be with me. At the end of the last installment, I'll transfer the ownership in your name. So this asset will be my asset. So when I buy this asset, machinery, equipment, it is asset in my balance sheet. It will be asset in my balance sheet. Okay. Now, the moment I record this asset in the balance sheet, did I make the payment now? No. I have to make the payment in installment. First payment I have to do within next 12 months of balance sheet date. So this 2 lakh becomes my current liability. And remaining 18 lakh payment when I should do? After the benchmark date, that is after the 12 months of reporting date. So this becomes my non-current liability. Now your question is, why this non-current liability? Arey Baba, you have purchased this asset, but it's from not your money, somebody else's money. So that person has put a condition that if you want the ownership of this asset, if you want the document to be in your name, you need to complete your installment of payment. So you use the asset, but ownership will be in my name. So when you pay the final amount, that time I'll transfer the ownership in your name. So I'm physically using the asset. So I've recorded the asset here, no? We are following double entry system of accounting. Equipment account debit is there. What is credit? Liability. Correct? No. So equipment account debit to liability. I have to make to that. I have to make the payment to the concerned person. When will I make the payment? 2 lakh rupees I'm going to make the payment within next 12 months. So that 2 lakh is my current liability. And remaining 18 lakh I'm going to pay after the benchmark date. So that becomes my non-current liability. Now the question here is that this non-current liability is what classification? I have 4 classification. One is long-term borrowing. Second is DTL. Third is other long-term liabilities. Fourth is long-term provision. DTL and long-term provision not possible. 2 options is there. One is long-term borrowing. Second is other long-term liability. Now, can I say this is financing means what? It is kind of loan that you have taken. So it comes under borrowing. But where under borrowing, separate item is created because this is a unique type of transaction. So the Schedule 3 is given a new name to it called as long-term maturities on the finance lease obligation. So I've taken one asset on finance, means borrowing. And the payment of this is happening on the long-term basis beyond the benchmark date. And this is non-current in nature. So here that 18 lakh will be classified as non-current liability under long-term maturities of finance lease obligation. Yes, boss.
So the 2 lakh is current liability and 18 lakh is
Non-current liability.
long-term borrowings.
Yes, correct. 2 lakh is current liability, 18 lakh is non-current liability. Yes,
And then you said
correct. I'm not, that's why I'm saying I'm not going into deep. The moment if I say higher purchase, then I have to explain what is higher purchase. What is the difference? Is difference there or not there, first of all? Do you think we have so much of time to discuss all that now? When the right time comes, the right things will be discussed. I'm discussing that point, which is essential enough to understand. At the same time, we can get going with the working out of the questions from the ICA model.
So you said the entry of sorry, equipment account liability. What is the credit?
That's what I'm doing. Accounting part is not been dealt with here. We are only discussing the classification. Please understand, you are a chartered accountant, not doing accounting, but you're doing reporting. You're doing financial reporting. So whatever disclosing, disclosure requirement. Accounting part will come back whenever accounting standard you deal. In that you learn the accounting part of it. Inventory, how we should record, recognize. So accounting aspect, recognizing aspect will be discussed in accounting standard. So when I come to the appropriate accounting standard, there we'll learn the accounting treatment also. Here we're trying to disclose the disclosure requirement from the Schedule 3 perspective. Here accounting standard also will come into picture. So accounting all will be done later. Guys, please understand, we are not doing accounting standard now. Listen. We are not doing accounting standard now. What are we doing? We are learning the format which is given by the company law. Company law is different, accounting standard is different. Please understand. Company law is telling that this is how I want the presentation to be. They are not instructing the accounting how it should be. So now the question what you're asking is the accounting treatment for this. Who will teach us? Accounting standard will teach us. Company law will never teach us accounting. Company law is telling that I want the financial statement to be presented in this manner so that those 7 people can understand the statement properly. How the accounting has to be done will disclose separately in the accounting standard. 1 to 29 accounting standards we have. There we learn the accounting treatment for all of this independently. Now we are only learning the disclosure of the company law. Now tell me if you have any problem in this. Any problem in this? So now, long-term borrowing you have to remember. Under this, just casually remember all this point. No need to remember in the specific order. Just casually you can write it. In exam, there is no need to write in any order. Sir, if deferred payment liability is given, can I write that as first? Yes, you can write it. You can change the order within the notes. You cannot change the order in the face of the balance sheet. Am I loud and clear? 100%. I told you this PDF will be given at the end of the chapter. A hard copy will be given to you. So I'll be giving you 2 documents. One is the short notes, summary notes, what I've prepared. Plus, you'll be getting one booklet, which you'll have. In that, you'll have questions of MTP, RTP, and PEP. Okay, so you have to refer 3 documents. One, ICA module. Second, my short notes. Third will be a scanner, which is having MTP, RTP, PEPs. All these 3, if you study, more than sufficient. MCQ question also I'll be giving you. Additional MCQs. Because 30 marks are from the ICA, from the examination perspective, 30 marks. So you'll be given that also. Now tell me if you have any doubts. So technically we're supposed to complete the liabilities today, but unfortunately we couldn't. So we'll take one more session to complete the liabilities. In the very same session, we'll also start the asset part. So I think 1.5 more sessions are required. So tomorrow is what? Saturday. So what time are we starting tomorrow? No, 5 o'clock. So you have 2 to 4 income tax class. So 5 to 8, 8:30, be mentally prepared. Ma'am, you are a CA student. Sunday we have 10 o'clock to 1 o'clock or 1:30 also it can go. My target is to complete this balance sheet format by Sunday. Sunday I wanted to start with the practical question. We'll start with ICA questions on Sunday. Monday also we'll have one more day class. Tuesday, Balle will happen because the foundation result is going to come. If it is coming, then Tuesday no class. If it doesn't come, then Tuesday we are having class.
Tuesday is coming, sir.
Tuesday? You're not audible to me. Anyways, chalo people, that's all. Let's wrap up. That's all from my side for this session, people. I'll see you all tomorrow, 5 p.m. sharp. Until then, bye-bye. See you. Take care.
Thank you, sir.
Thank you.
Thank you, sir.
सर डेट कंफर्म हो गया ट्यूसडे रिजल्ट आ रहा है